Hello everyone, welcome back. Hi, my name is CA Bhavan Gandhi and today we are going to do theory of financial management. So my dear students, this is the most comprehensive video on your theory for your financial management. And in this particular video, I'll be covering theory from your study module. And along with that, we'll be referring to your past year papers as well as your RTP. So do watch this video towards the end to get your theory exclusively and comprehensively covered. And in this particular video, we'll be referring to exclusive theory chapters of a study module, which is your chapter number 1, chapter number 2, and also some part of your financing of working capital as well. And I have summarized the entire theory along with explanation of concepts. So how to watch this particular video? You can watch this video by remembering the concepts along with me in the class. So basically, I'll be making you remember important concepts, important points here only along with the video. So what you have to do is, whenever you feel that, this point is important, or whenever I tell you, try to remember this. So just pause this video, go through the points, just remember the main points so that your entire video, when it gets completed, all the concepts, you are able to remember it here along with me only. Also, if you want, you can keep your notebook and a pen handy. Whenever you feel that there are important points, you can just pause the video and write down the important points. But don't just see and watch the video. Rather, it is important that you understand and memorize along with me, and also at the same time make important notes whenever you feel like. Now, my dear students, I am going to take this particular video in English. Why? Because we have to present the solutions in your English language only. So for those students who are watching from from Delhi, from Kolkata, from Jaipur, etc., and those students, they are more comfortable in Hindi, I know, but this entire video, why I'm taking it in English is because so that you understand the language, you can recollect it, and whenever it comes to writing down the paper, you will be able to write down in this appropriate language only, then you'll be getting the marks for the same. So that is why I'll be conducting this entire video in your 100% English language. Okay. Whenever you feel that if there is something which you have not understood, you can definitely ask me. But I'm very sure that you'll be able to understand it because I've simplified even the toughest theory concepts in the most easiest way. Okay. Now, as you all are aware that theory is extremely important from the examination perspective because you can have MCQs and case studies based on this theory. You can have some important questions which can be part of your compulsory question as well. And if suppose there is an out of the box question, then theory question can come to your rescue. Okay. So let us do this theory now as fast as possible in the most conceptual way. Okay. So let us start now with the first chapter of your theory, that is your scope and objectives of financial management. Okay. Now this is primarily your first chapter of your study module, in which they have asked you about what is financial management, what is the role of a CFO, what is profit maximization, wealth maximization, what is the relationship of FM with your other streams of accounting. Okay. So basically, when it comes to your financial management, then there are three types of decisions which a CFO has to make. Okay. Now, basically, whenever you are studying financial management, we have to think that we are studying financial management from the company's perspective, and who manages the finance, then it's always the CFO. Now, when the CFO is going to manage the finance of the company, will he be involved in decision making? Yes or no? Yes. And then there are three types of decisions which are made by a CFO. What are the three types of decisions made by a CFO? The first one is your financing decision, which deals with how to raise the finance. The second one is your investment decision, which deals with where to invest your capital. And the third one is dividend decision, whether we have to distribute your equity dividend or not. So whenever it comes to your basic introduction about your financial management, what should come to your mind is that in financial management, we are going to manage finance of the companies. Who manages it? CFO. Is he involved in decision making? Yes. The objective of making decision is to maximize the wealth of equity shareholders. And how many types of decision a CFO has to make? Three types. The first one is how to arrange for your capital. Second one is where do we invest it? And third, whether we distribute your equity dividend or not. Okay, so these three important points you have to remember. Now, my dear students, when it comes to the meaning of a financial management, we have to arrange your resources. We have to utilize your resources in such a way that we have to maximize the wealth of equity shareholders. Okay, this is the most important aspect which you have to understand. Maximizing the wealth of equity shareholders. Now, there are two important aspects of your financial management. One is procurement of funds or arrangement of funds, and second is utilization of funds. So when it comes to your arrangement of funds, so these are the 5 important sources which they have mentioned. That is debentures and bond, angel financing, venture capital, commercial bank, owners funds. But my dear students, here we have to understand this, that whenever we are going to arrange for the funds, the 3 most important aspects which you have to take into consideration is your risk, cost, and control. So risk, cost, and control. These are the 3 primary aspects which you have to understand when you are going to arrange for the funds. So whenever you will be taking a fund, then which all 3 important aspects which you should see: what is the risk of the fund, what is the cost of the fund, and what is going to be the impact of that fund on controlling the organization. So basically, when we are arranging your funds from debt, so debt basically will have a higher element of risk involved in it. Cost will be relatively lower, and absolutely there is no control over the company until unless if there are secured debentures. So you know that for the secured debentures, if suppose we are not able to repay them, then they have a right over the assets of the company. But when it comes to decision making, then this debenture holders will definitely have no impact when it comes to making decisions. So basically, whenever we are arranging for the funds, 3 primary aspects which we should take into consideration, that is nothing but risk, cost, and control. Okay. And what are the different sources from which you can arrange for the funds? So now this is something which you have to remember it. Then the first part is equity. It can be a source. Second is your debentures. Third is when we can fund from your banks. Fourth is international funding. Fifth is angel financing. So these are the 5 primary aspects on how we can arrange for the funds. Now I have highlighted the important parts of the same. So what you can do is that whenever I'm discussing equity, so in equity, just remember this statement. Okay. And then you can just try to explain this concept of equity on your own in your examination. Okay. So now the first and the primary source on the basis of which a company can arrange for the fund is by the way of equity. So when it comes to equity, so here we have to remember that this is the most expensive source of fund. Why? Because equity shareholders, they are going to expect the highest from the company. And when they are the true owners of the company, their expectation is going to be the highest. So definitely company has to meet their expectations. So their cost of equity is also going to be the maximum. So equity shareholders, they are the true owners of the company. So that is why their expectations from the company is going to be maximum. They are the maximum risk takers. So that is why the company has to fulfill the expectation of the equity shareholders by keeping the highest cost of equity. Okay. So that is why it's one of the most expensive source. When it comes to debentures, of course, they are comparatively cheaper, because when it comes to taking, secured debentures. So when we are going to issue your secured debentures, you are aware about the fact that the risk element here is going to be minimum. Okay. So risk is going to be minimum, and that is why the cost of the secured debentures is also going to be relatively lower as compared to the cost of your unsecured debentures. Okay. So here we have to always understand that risk, cost, and control. These are the 3 primary aspects on the basis of which we source a particular fund. Okay. Now, when it comes to taking loans or funds from the banks, then the first thing we have to check is whether we are taking from long-term perspective or short-term perspective. Now, when it comes to your fund-based methods, so basically there is cash credit. So these are the different elements or parameters when we can take the loan from the bank. So by the way of cash credit, by the way of overdraft, by the way of term loans, working capital loan, bill purchase or bill discounting. And non-fund based means your guarantee and your letters of credit. So apparently what happens is that many times bank gives you guarantee. So when you want to take funds or take credit from someone outside the country as well, then the bank can offer you letter of credit based on which you can get those particular funds. Okay. So that is something which will be discussed in much more detail in the next chapter. But these are the different sources on the basis of which you can arrange the funds from the bank. So what are the sources? You are already aware about it: cash, credit, overdraft, term loans, working capital loans, bill discounting, and then we can also have guarantee and your letter of credit. Now see, something like this can be asked in your MCQs as well. From the following, from the following options, which of these are, non-based, non-fund based sources from banks? So then there will be overdraft, term loans, bill purchasing, and then they can give you letter of credit. So you know that letter of credit can be treated as your non-fund based. Okay. Then my dear students, we have something which is called as international funding. Now when it comes to international funding, it means what? We are going to raise the funds outside India. And how can we do that? So by the purpose of issuing your global depository receipts or American depository receipts. So GDRs and ADRs, just remember this two terminology when you are going to raise the funds outside the country. Okay. And then you can also attract FIIs and FDIs for the purpose of investing in the equity of your particular company. And angel financing. So angel financing, basically they are primarily your first source where they are going to trust your business idea and startup, and they'll be investing in your equity of the company, and they are going to help you for the purpose of expansion and growth. So angel financing, they will actually help you out with financing by purchasing the equity of your particular company, and they can invest around 25 to 60% of the equity, and this will help the particular company to get idle cash which can be utilized for the purpose of expansion and growth. So angel financing, are they going to invest in the equity of the company? Yes or no? Yes. And what is going to be the percentage stake? Somewhere around 25 to 60%. Now they are going to help you to invest in the equity of the company, and you can expand and grow based on the amount of equity which you have. Okay. Based on the amount of the funds which you have by selling your equity. So angel financing basically deals with startups for the purpose of expansion and growth. Now, my dear students, these are the 5 important aspects which you have to understand. So if they ask you that what are the basic sources of funds and what are the considerations which you have to take into place when you are going to arrange for the funds. So 3 important parameters: risk, cost, and control. And these are the 5 important sources which you have to take into consideration. That is equity, debt from banks, then international funding and angel financing. Okay. Now, how do you utilize your funds? So of course, there are 2 primary aspects where you're going to apply the funds: on the fixed assets of the company, and second is in the working capital. So obviously fixed assets and working capital, because I hope you all know that once the funds are being sourced, now we have to apply those funds. So we can invest in plant, machinery, land and building, etc. But to function that plant and machinery, land and building, etc., we need some amount of working capital. So that is why utilization of working capital, that also plays a very important role. So 2 important application of funds. First is fixed assets, and second, it is your working capital. Now, my dear students, evaluation of financial management, not that important. Traditional, transition and modern phase. So in traditional phase, what used to happen in financial management was, it was only taken into consideration when there were takeovers, mergers, acquisition. Only then the FM was being considered for the purpose of takeovers, mergers, etc. But when it came to your transition phase, your day-to-day operations, FM is important. Modern phase deals with your forecast, and for all those things, your financial management is essential. So how your FM has evolved from traditional to transition to modern phase. So not that important from the examination perspective. Now, when we deal with the valuation or what is the function of a particular financial management. So basically financial management is a function of 3 important decisions. And whatever we have discussed above, the same thing is elaborated here. First is your investment decision. Second is your financing decision. And the third one is your dividend decision. So basically when it comes to investment decision, where do we invest? We invest in the fixed assets. We invest in working capital, as we have just now discussed. So this is something which you already know. You can elaborate this in your examination as well. Financing decision, how do we acquire? How do we source our funds? So as I told you, we take into consideration risk, cost, control. Based on that, we arrange for the funds. You know the various sources on the basis of which the funds can be arranged. And then dividend decision, it deals with whether we should distribute your equity dividend or not, where you can always take into consideration that when the company is expanding and growing, then in that particular case, they will need the profits for the purpose of expansion and growth. So we are not going to distribute your equity dividend. And when the company has already reached the level of saturation, they can definitely distribute your equity dividend. Okay. So these three decision makings are extremely important. Then working capital management also forms part of your decision making, but investment in current assets, etc. is already covered in your investment decisions. So three important decision makings which you have to understand. So arrangement of funds, financing decisions, application of funds, investment decisions. Third is dividend decisions, whether to distribute your equity dividend or not. Okay. Now, importance of financial management. Now, these are the points which you can understand in importance of financial management. So not to over invest in your fixed assets. Okay. So that, you don't face a problem of low asset turnover ratio. Always try to apply the funds in such a way that you have efficient utilization of your assets. Then balance your inflow and outflow. Then how do we manage your short-term working capital requirement? Then setting the sales revenue targets, that is also part of your financial management. Then increasing your gross profits by setting the correct profits, etc., profit margins. And then controlling the level of general and administrative expenses and tax planning. So basically taking care of your fixed assets, inflow outflows management. You should not run out of your cash deficiencies, etc., and you should have surplus cash available with you. Then you have to set up the sales revenue, improve your profit margins. All these basic primary thing is part of your functions of your financial management, tax planning, etc. Okay. Now, scope of financial management, that whenever we are going to do management of finance of companies, we have to do this financial management after considering what should be the size of the enterprise, what is the composition of the assets, what is the debt equity mix, and then we have to analyze, plan and control based on that. Okay. So when it comes to your financial management, we cannot apply the same principles of financial management for the same type of companies. We have to be very dynamic and modify the same depending upon the size, composition of assets, etc., and then make the decisions accordingly. Okay. Role of financial controller. Now, when we'll be doing PYP questions, you'll be understanding it is one of the most important part, and they ask you questions on the same. So basically, a financial controller, it means the CFO of the company is primarily involved in decision making with only one simple objective, and that is nothing but what? That we have to maximize the wealth of equity shareholder. For that, we have to make the decisions. And what are the three important decisions? Again, it is getting repeated. Your financing decisions, your investment decisions, your dividend decisions, and then understand the relationship between risk and return when it comes to making the decisions of the company. Now, this is one of the most important part of your financial management. That is nothing but objectives of financial management. So there is something which is called as profit maximization and wealth maximization, and Institute has very frequently asked the difference between profit and wealth maximization. Now see, when it comes to profit maximization, we are only concerned with maximizing the profits of the company. So very simply, if I put it, how do we maximize the net profits of the company? So we have to just simply focus on maximizing the profitability of the company over a particular period of year, or maybe for some number of years. So profit maximization is a very short-term concept, and wealth maximization is a very long-term concept. Now, when it comes to a profit maximization concept, it deals with what? That how should we maximize the profits of the company by taking some projects, even though it is risky in nature, but only because we want to maximize the profits of the company, then we might take into consideration such kind of projects which are extremely risky, but it can help in generating the profits of the company. Now, when you are making decisions as a CFO of a company, should you go for such kind of projects which has higher element of risk? Then the answer is no, because we should always make investments from long-term perspective, and that is your wealth maximization. So basically, it is very simple that when you want to invest in stock market. Now, when you know that there are certain trades which are extremely risky, but it can give you higher profits from the short-term perspective, but wealth is always created when you make the investments from long-term perspective. So that is why wealth maximization should always be preferred over profit maximization. So whenever we make investment in stocks, what do we basically focus on? We focus on your wealth maximization principle only, right? Isn't it? So basically, wealth maximization deals with what? It deals with your long-term objective of maximizing the wealth of equity shareholder. So even if suppose a particular project gives you a high amount of profits from the short-term perspective, but it has a greater element of risk, should we select that particular company? Then the answer is no. But rather we should select a company in which we should select a project in which, you know, though the short-term profits are lower, risk element is lower, but it results in a higher wealth generation for equity shareholders. So that should be the objective. Okay. So the term profit itself is very vague. Okay. And it is only from, you know, basically main from the short-term perspective and not mainly from the long-term perspective. And it's a direct relationship between risk and profit. So as I just told you, you know, when it comes to direct relationship between risk and profit, so some projects or some investments can have a higher element of risk, but higher element of risk and higher generation of profits does not necessarily mean wealth maximization from the equity shareholders perspective. Okay. And then it does not take into consideration your pattern of returns. Now, sometimes, you know, what happens that if suppose there is a particular project, you know, from a long-term perspective, let's say, for example, that project is going to give you cash flows for the period of 5 years. Okay. Now, suppose there is one particular project A, which gives you cash flows over the period of 5 years, and it generates into a higher profits as compared to project B, which gives you, you know, more cash flows in initial years and less cash flows subsequently. Now, in this particular case, if I take project B into consideration, then can I say that my payback period is relatively lower? Now, when the payback period is relatively lower, what does that mean? That though the profits are lower for project B, but if the payback period is lower, risk element is lower, I can generate more cash flows, and those cash flows I can invest it somewhere else as well. And then I can, you know, recover my investments and use that investments to generate a higher return by making investment in some other projects. So basically what happens is that wealth maximization can be possible when we make investments in a project with lower profitability. Listen to me very carefully. With a lower profitability, but a lower payback period as compared to a project which has a higher profit by a higher payback period, because the risk element there can be relatively higher. So a particular project which has a lower profitability but a lower payback period, that can help you to recover your investments faster, and then we can make that investment in some other projects and generate more returns from that other projects as well. So that's what they meant. They have mentioned that, you know, proposal B may be preferred, which may have a lower overall profitability but a higher return flow, can be more real and quick. So we can apparently have a higher returns, a higher payback period, a higher way in which, you know, the amount which we can recover it, we can invest it somewhere else and generate more returns from the same. Okay. So your profit maximization basically is too narrow. Okay. But wealth maximization is very broad. So when you're a CFO of a company and you have two projects in front of you, one project short term in nature, okay, higher risk and higher profits, another project which is apparently, you know, giving you more value creation, more wealth from the long term perspective, then we should always go and make decisions in a way that your wealth of the equity shareholder should be maximized. Okay, so don't just focus on profit maximization. So what is your wealth creation? It is nothing but present value of benefits minus present value of cost. That is something which we have already discussed in your investment decisions. Okay. So basically we have cash flow approach, cost benefit analysis, and application of time value of money. We consider all these three important aspects when it comes to your wealth creation. Okay. So what is going to be your cash flow and not accounting profits? Because in your investment decisions, I've discussed this, that only accounting profits is not important when we make decisions in a project. What is more important is the cash which is getting generated from the project. Okay, because it is the cash which we are going to reinvest it. So accounting profits are just merely your book profits, where we take into consideration, you know, your cost, etc., and depreciation, etc., which is taken into consideration. But cash profits, cash flows, that will give you a correct picture, because that's the amount which you have for the purpose of reinvestment and decision making. Okay, and then we apply the time value to money. So value of the firm can be calculated by taking into consideration your number of shares into market price, or we can take value of equity plus value of debt. So this is how we calculate the value of the firm, which we have also done it in subsequent chapters like cost of capital, etc. So whatever is the number of equity shares, we multiply that by market price per share, or we take the value of equity and value of debt, both these things, to calculate the value of the firm. Okay. Now, wealth maximization is important, okay, and these are some other goals, which is higher growth rate, large market share, etc. Not that important from the examination perspective, okay. So primary goal is to maximize the wealth, okay, and as it is critical for the very existence of the business enterprise. Now, this point is very important, and ICAI have asked you very important questions on what is your wealth profit versus wealth maximization principle. Okay, so for that, this table is extremely important: profit maximization and shareholders wealth maximization. Try to remember this along with me here only. Now, profit maximization focuses on what? Large amount of profits. Now, large amount of profits. So a particular project which can generate higher profits, and we are not concerned with what is going to be the impact on the wealth of the equity shareholders. We are just concerned with that your net profit should rise. Okay, that is the whole and sole objective. Okay, and shareholders wealth maximization focuses on what? It focuses on highest market value of the shares. So make decision in such a way that market price of the share per increase. Okay. Now, what are the advantages? So advantages are, it's very easy to calculate the profits, easy to determine the link between financial decisions and profit. So basically, you know, example, ARR method, accounting or average rate of return method, which we have discussed in your investment decision chapter. There, what we take into consideration that a project with higher ARR, we should focus on that. So it does not take into consideration your cash flows, what is going to be your payback period. It just focuses on the net profits. Okay. But here it focuses what are the advantages of your wealth maximization. So long-term perspective, it recognizes risk and uncertainty. It recognizes the timing of returns, and it considers shareholders returns. Okay. So wealth maximization focuses, as I told you, that when we are focusing on wealth maximization, we are considering your payback period as well, right? So we are considering the stream of cash flows as well. And here we are just focusing on accounting profits. And here we are focusing more on your cash flows. Okay. Now, what are the disadvantages? So there is so much emphasis only on short-term gains. It ignores the risk. It ignores the timing of returns. And it requires immediate resources. But here there is no clear relationship between financial decision and share price, and it can lead to management anxiety and frustration. So sometimes, you know, what are the disadvantages of shareholders wealth maximization is that we, from the long-term perspective, make very wise decision, but still the market price of equity share sometimes does not reflect based on that decisions. So that is why it is possible that it can be more frustrating for the CFO of the company. Okay. So apparently, I'll just give you one very simple example to make you understand this. That, let's say, for example, you know, you have a great project in front of you, project A, which gives you maximum returns, over the period of, let's say, 3 years. Okay, it gives you maximum returns for the period of 3 years. But the risk element here is also extremely high. Okay, it has a very high element of risk. Okay, because we don't know that this particular project will give you this much returns or not. So suppose you are investing in a sector which has a very high element of risk, and when you are financing yourself, by the way of debt, you know, higher proportion of debt. Okay. Now, in this particular case, it is possible that the EPS can go up, but because of lower P ratio, then the market price of the share can fall. So it can look very good, very lucrative from the purpose of your accounting profits. But when it comes to maximization, then it is possible that the wealth of the equity shareholders, the MPS of the share, can fall because of this investment decision. So will you make your decisions only and only based on profit maximization? Then the answer is no. Okay. So once again, profit maximization only focuses on profits. Here it focuses on increasing the market price of an equity share. What are the advantages? It calculates only your profit maximization. It calculates only your profits, and then the projects can be linked to the profits, and ARR is one of the example on the basis of which the decisions can be made. But what are its disadvantages? It only focuses on short term. It does not consider risk. Okay, so you can just remember 2 points out of it, that it focuses only on short term and it ignores the risk part. Okay, here it focuses on long term. Okay, but then sometimes after making decisions based on this, the share price does not get changed because of that, so it can lead to frustration and anxiety from the management perspective. Okay, so this is the basic difference between profit maximization and wealth maximization. Okay, now what is the role of a finance executive? So as we have discussed, there is financial analysis and planning, investment decision, structuring decisions, how to use your resources properly, and how to manage your risk. Okay, so what does a CFO does now? So these are some of the points which you can just understand it and write down in your own words as well in the examination. That is budgeting, forecasting, mergers and acquisitions, how do you manage that, profitability, check the prices, decisions about outsourcing, check the overall IT function, HR function is now also seen by the CFO of the company, strategic planning, regulatory compliance, and risk management. So all this is something which is done by a CFO now. Okay, what is used to be done, that is something which ICAI will never ask. So what is the current role of a CFO? So these are some of the points which you can just go through it. Okay, now what is the meaning of financial distress and insolvency? So when we are not able to repay our obligations, we call it as insolvency. So when the proportion of debt, they have to be managed very properly by the CFOs of the company, because higher debt requires higher interest and higher, sometimes the cash flow is not sufficient, then it can put a lot of pressure to the organization. So insolvency basically means what? Inability of the firm to repay various debt, and it's a result of continuous financial distress. So if they ask you a note on what is financial distress and insolvency, so you all know that this is occurred because the company takes more amount of debt in the capital structure, which can result to higher interest cost. And because of that, if your cash flows are not sufficient to repay that particular amount, then it can result in insolvency. Okay. Now, what is the relationship between financial management with other related disciplines, that something like accounting? So basically in accounting, what do? Is we just record the entries, we take into consideration accrual system of accounting, and based on that we just record the transactions of the company. But when it comes to your management principle, financial management, as I was just telling you that we were just taking into consideration an accrual principle, but when it comes to management decision making, here we take into consideration what is going to be financial planning, controlling, and decision making. So which has a very larger scope, a wider scope? Is it financial accounting or financial management? Financial management. Accounting has a basic purpose of recording the transactions, but when it comes to your decision making, your financial management plays a very important role. So we are just collecting the data and presenting the financial data of past, present, and future operations when it comes to financial accounting, and the financial manager uses this data for your decision making. Okay, so if they ask you what is the relationship between your financial accounting and your financial management, so your accounting takes into consideration only your data entry, presentation, etc. But when it comes to your management, here we have to use that particular data for your decision making, for better planning, control, and decision making. Okay, so that is something which you have to just pay attention on. Now, what is this agency problem and agency cost? Now see, for sole proprietors, as you all are aware, that the sole proprietors themselves, they are the fund managers, they are themselves are the decision makers. But when it comes to company, when you are purchasing equity shares of the company, you are the true owner, but the management is different. So the one who is managing the funds of the company, that is a CFO, that is a different person as compared to the owners of the company. So this difference is called as an agency problem. So when you have purchased the equity shares of Reliance Industries Limited, then can I say you are the owner of RIL? Of course, yes. So you are the owner of RIL. But are you the one who's also managing funds of RIL? No. So that is managed by whom? The CFO of RIL. So the basic difference between owner of RIL and CFO of RIL is called as a agency problem. Okay. Now, because we have appointed an agent who is going to manage the funds of the particular company. Okay. Now, how do we, manage this agency problem? So we can, because there's a conflict between owner and the CFO, because CFO is not the owner of the company. He's going to just make the decisions on behalf of the owners of the company, right? So you, me, we all are the equity shareholders of the company, we are the true owners, but we are not the managers or the fund managers of the company. So this agency problem, this conflict, this disparity, we can avoid it when we give this particular CFO complete authority, where the decision should be made with an objective to maximize the wealth of the owners of the company and not merely profit maximization. Also, at the same time, we can link their salaries with whatever is the wealth which is getting generated by the equity shareholder. Based on that, their performance can be taken into consideration. So all this will actually help to cure this agency problem, and this agency cost can be managed properly. Okay. So there is a principal agent relationship between managers and the owners, which is also known as agency problem. Okay. So agency cost is nothing but what? That this shareholders of Reliance, they are bearing this additional cost to monitor and manage the control of the behavior to maximize the shareholders' wealth. Okay. So this is the basic difference between agency, between your owners of the company and the managers of the company. Okay. So agency problem between managers and shareholders can be addressed if the interests of the managers are aligned to the interest of the shareholders, as I told you, to maximize the wealth of equity shareholders. Okay. So then, we can have the compensation linked to the profits of the companies and to the long-term objectives of the company, and we can do effective monitoring in such a way that all these things can be managed. Okay. So my dear students, this is your first chapter theory. Okay. Questions regarding the same, of course, in PYP, RTP, etc. will be discussed, but these are the concepts which are discussed in the first chapter. Okay. So now let us continue with the next chapter, and that is your types of financing. So now very quickly, first let us understand that what are the different types of instruments which can be used for the purpose of raising finance. So here there are many types of instruments, and we have to remember the features of every type of instrument. So I would just request you that you can do this, remember this along with me, and also at the same time, if you want that any particular feature, if you find this is the feature of this particular bond, you can just write down that beside your study module or make a note of it. Okay. Now see, for any particular company or a business, there are three main types or needs for finance. One, it is long-term financial need. Second, it is medium-term. And third, it is short-term. So when can we call it a long-term financial need? When the funds are required for a period of 5 to 10 years. When do we call it? It is a medium need when it is less than 5 years. Okay. And short-term means what? That when we have to invest in stock, debtors, etc. So basically, every type of need which is required for the purpose of raising a finance will be met by specific type of instruments. So now if suppose I want to, let's say for example, invest my money in stock. So then in that particular case, I'm not going to issue debentures from long-term perspective and use that money for the purpose of making investment in stock. So then there are working capital, bank overdrafts, cash credits, etc. that can be used for the purpose of meeting your investment in stock. So the first thing is to establish that for any particular CFO, what are the three main types of requirements: medium term, long term, medium term, and short term. And how are we going to meet those? That is going to be met with the help of different type of financial instruments, right? Now see, let's say for example, if suppose for any particular company at the early stage, if they are at the early stage of their business, then of course the nature of the business is highly uncertain because they have just now started with a particular venture. Now what should be the main source? So as a CFO, what should you do? You should try and raise the funds by equity, and that is also by angel funds, because they are going to trust your idea and they will make the investments there. Okay. Now if suppose in your early stage, okay, there is moderate uncertainty, then we can go to venture capitalist, or we can take the money from equity shareholders, or we can raise the money by the way of the debt. Okay. But if suppose, let's say for example, you have just now started with a business idea, but you don't know how you are going to proceed with the same, then what you are going to do? You are going to first approach angel funds. If there is moderate uncertainty, then we will go to what? Venture capitalist, or take the money by the way of debt or from the equity shareholders. But when you are at a growth stage, now that is the time when venture capitalist will be taken into consideration, private equity will be taken into consideration, and debenture holders will come. But when you are at a stable stage, then in that particular case, banks are only willing to offer you loans. So when you're already at 10 years, 15 years of a business and maintaining stability, then the source of fund can be debt. Now, why debt? Why? Because this is the cheapest source of fund. Okay. Because here the risk involved is the least, because you're already at a stable stage of the business. Okay. Now, once again, if you are doing a business where the uncertainty is maximum, then take the money from angel funds. When it is moderate uncertainty, take the money from venture capitalist. When you are at a growth stage, take the money from venture capitalist or equity or debt, private equity. Or whenever you are at a stable stage, then in that particular case, why to raise funds by the way of equity? It is better that we take the money by the way of loans and enjoy the financial leverage benefit on the same. Okay. Now, my dear students, in this particular case, from long term, from medium term, and from short term, these are the different nature or the sources from which you can take the funds. We'll be discussing each and everything in much more detail. Okay. One by one, we'll start. So the first one is nothing but your what? Equity capital. Now, what are the features of equity capital? Now, something like that, if it comes to your examinations, you know that what are the main points you have to write down. So equity, they are the permanent capital, right? And then they are going to undertake the highest level of risk. Okay. Then the dividend, which is payable, is an appropriation of profits. It means that it is distribution of profits, and it is not the charge against the profit. Now, this is something which you know, that it's not debited in the P&L account, right? It's an appropriation of the profits. And then also at the same time, when there is winding up of the particular company, then it's the equity shareholders who are going to get the money towards the last. Okay. And then the cost is the maximum because they take the maximum risk. And also at the same time, you can also expand your equity base with the help of new issue, right issue, bonus shares. So basically it's a permanent capital. Then also at the same time, they take the highest risk. Cost is also high. Dividends are not debited in the P&L account, but it is appropriation of the profits, right? And the cost here is maximum. So these are some of the points which you can write down. So these are the advantages, that it is the highest, it's the permanent source of your finance, and we are not obliged to pay any dividends. So it's not a fixed commitment which you are going to bear. Okay. And then we can also issue more capital by issuing your right share. So these are some of the advantages, that it is permanent in nature. There is no need to pay any fixed dividend. And also at the same time, you can also issue right shares to your existing equity shareholders and enhance, your equity base. But what are the disadvantages? That the more and more equity which you issue, can I say that it can have an impact on the controlling stake of the company? They can have an impact on the decision making. Also, the EPS can be diluted, right? Voting power increases, etc. So then there is uncertain dividends. So from the equity shareholders, they will not prefer investing. Reduces the earning per share. Then reduces the ownership and controlling stake can also be taken into consideration, right? So this was the first part, that was equity share capital. Perfect. So I hope you have understood what are the features, advantages and disadvantages. Very basic. But when it comes to preference shares, so for your preference shares, what you have to understand, that here also these are long-term funds, normally just like equity, these are also long-term in nature. Such shares are normally cumulative. Now, what does cumulative mean? It means that dividend payable in a year of a loss gets carried forward in the next year when there are adequate profits to pay. So in 1 year, if there was a loss and the company could not distribute the profits, then what happens in the second year? Whenever there is a profits, the company will distribute, the dividends for the earlier year as well. So that is one of the advantage, okay, of your preference share capital. These are generally cumulative in nature. The rate is also higher than the rate of interest, etc., and it is already prefixed. And most preference shares carry a stipulation period. So redemption is also there. That is one of the advantage of it, right? And it is always remember that preference shares are hybrid form of instrument. Now, what is hybrid? When it contains the features of equity and debt both. Why equity contains features like equity? Because you are going to receive dividends. And also why debt? Because there is a fixed rate of obligation which you are going to get it. Okay. Now, of course, this dividends, etc., is not allowed as a deduction in the P&L account. Now, cumulative convertible preference shares, sometimes these shares are issued in a way where it can be converted into your equity shares after some period of time. Okay. And then preference shares may be redeemed at a prefixed price. So these are some of the features. Okay. So, instead of remembering this in the point form, these are various types of references. You can understand it. Where if it is cumulative, so arrears dividend can be accumulated. Non-cumulative, there is no right to receive any dividend. Redeemable means what? Redemption, it is necessary, it should be done. Participating means what? Can participate in the surplus which remains after the payment to the equity shareholders. So after the payment has been done to the equity shareholders, any profits which remains, then in case of participating preference shares, the preference shareholders also have a right towards it. So just imagine a situation like this, that out of 100, let's say for example 20 is paid, so 80 is remaining, then they can also have a right towards this 80, that is participating. Non-participating means they only carry a fixed rate of preference dividend. And convertible means it gets an option to get it converted into equity shares. But remember that preference shares are also from the long-term perspective. Okay, so these are some of the benefits of it. But what are the main advantages is there is no dilution in EPS, because whenever there are preference shares, what do? We take into consideration, preference dividend. So from NPAT, we subtract the preference dividend, and net profits for equity shareholders, we divide that by number of equity shares. So whenever a particular company is issuing preference shares, the first thing which you should come to your mind is there is no impact on the earning per share. Okay, because it does not get into dilution. When we issue equity shares, more number of equity shares will be issued and the earning per share is going to fall. Now, there is also advantage of financial leverage which can come, because whenever you make the fixed payment of preference dividend, after that, how much money you have earned because of the preference shareholders, that belongs to you, right? Suppose your return on capital employed is 30%, and if you have issued the preference shares just at the rate of 8%, so even after making the payment of tax and after giving the payment of the preference dividend, the balance belongs to you. So you enjoy a higher, favorable financial leverage based on this. Okay. And here the preference dividends are fixed and pre-decided. So it's advantages for both, for the investor as well as for the company, because they know their fixed obligations and they can also be redeemed. But what is the disadvantages? Now, from the company's perspective, one of the biggest disadvantages is whenever there is preference dividend, my P&L account gets debited, but I don't get any tax savings for the same. And if they are cumulative in nature, it means what? Whenever there is any loss, subsequently when there is a profit, then I have to, again rearrange for the funds and give it to them. So that is one of the disadvantages. So advantages, what are the advantages? No dilution in the EPS. You get favorable financial leverage. Dividends rate are fixed, and there is a redemption which is going to be possible. And what are the disadvantages? No tax savings. And also if they are cumulative in nature, whenever there is a loss, I have to, whenever there will be a loss, I will not pay the dividend in that year, but subsequently I definitely will have to pay the dividends for the same. Now, this is something which you have to understand. The third part is your retained earnings. Now, retained earnings means what? Okay, see that this distinguish is very easy. If you know equity shares and preference shares, you will be able to find out this particular part. Okay, what is this distinguishing part? And here the important part is that equity shareholders, they will enjoy full voting rights. And your preference shares, they only enjoy limited voting rights. Okay. Now, retained earnings. Can I put it like this? Retained earnings are nothing but the profits which can be used for the purpose of your expansion and growth after distribution of dividends. So these are, accumulating the profits of the company and by plowing them back into the business. Now, again, using them back to the business. So the best part is there is no cost which is attached. We are using our own funds for the purpose of expansion. The only cost for your retained earning is nothing but the cost of equity, because it's equity shareholders funds which we are using it for the purpose of expansion and growth. So that is why whatever is your KE, that is nothing but your KR. So we don't have any fixed obligation for the same, but the advantages and disadvantages of your primary source of equity, that can be applied for your retained earnings as well. Okay. So this is one of the source, and then we have something which is called as debentures. Okay. So debentures also, my dear students, these are also from long-term perspective, and these are issued in the denomination of 100 to 1000. Generally, there is 3 to 10 years. They are both secured and unsecured. Okay. So this is the face value. This is the tenure, secured, unsecured. They may or may not be listed on the stock exchange. Okay. And here the rate of interest is quite low. So this is something which you have to understand, that from the company's perspective also, the cost of capital for the debt is extremely low. Okay. And also this interest is allowed as a tax deduction. Okay. And they are, from the investor's point of view, debentures offer a more attractive prospect than a preference shares, since the interest on debenture is payable whether or not the company makes the profit. So for preference shares, you are only going to get the preference dividend when they are going to earn profits. But for interest, you are going to get the interest whether the company is loss making or profit making. Okay, so these are some of the features of your debentures. Okay, so once again, face value 100 to 1000, life is 3 to 10 years, long-term source of finance, secured or unsecured, may or may not be listed on the stock exchange, right? And also interest rate is lower, you can get the tax benefit also on the same. Okay, from the investor's perspective, debentures should be preferred over the preference shares. Okay, because you are going to get your interest irrespective whether there is any profit or loss in the company. Now these debentures can be listed into 3 categories. What are the 3 categories? Non-convertible, fully convertible, and partly convertible. So non-convertible means what? You are going to get your money at the time of redemption. Fully convertible means you are going to get fully equity shares at the time of conversion. And partly convertible means partly cash and partly equity you are going to get at the time of the conversion. Okay. Now, what are the advantages? So lower rate of interest. There is no dilution in the control because debenture holders, they don't have any voting rights. Also, they are not part of the equity. Only after conversion, there can be a possibility. But for the timing, there is no dilution at all. Okay. And whenever, in the market, inflation increases, cost of interest is also going to rise. If in the market, they are going to rise the cost of interest, etc. You don't have to worry. Why? Because for you, you have actually issued the debentures at a fixed rate. So that is why debentures are much more advantageous to you. Okay, because the rate of interest is actually fixed. Okay. The disadvantages, that you have to compulsory pay the interest whether there is any profit or loss in the company, right? And debenture interest is an obligation. Okay, so there is an obligation when it comes to your debt. Also, here the debenture financing enhances the financial risk. Now, as you all are aware, if the debt equity ratio is higher, then obviously we can put it in this words that the risk in the company keeps on increasing. Higher the debt equity ratio, higher the risk. Okay. And debentures need to be paid maturity. Large amount of the cash flow will come when we are going to redeem the debentures. Okay. So this is the basic distinguish between preference shares and debentures. Here you have to understand that preference shares, they have some characteristics of debt and equity both. And here, they are for long-term perspective with the fixed rate of maturity. Okay. Now bonds. Now see, usually bonds carry the same characteristics as the debentures, but there are 2 main types of bonds called as callable bonds and puttable bonds. Now what happens is, let's say for example, if I am a company, now I have right now issued the debentures at the rate of interest of 10%. Okay. So I've issued the rate of interest, which is nothing but debentures. I've issued it at 10%. Because in the market also right now the interest rate is going on, which is 10%. And suppose the life of the bond is 10 years. But I think that after the period of 4 years, the rate of interest in the market will fall at 7%. Now in this particular case, what will I do? Now just imagine if I have issued the bonds or the debentures for the period of 10 years, where the rate of interest is 10%. Now after 4 years, if the interest rate in the market falls, it means that people can get the loans at 7% rate. So I have stuck myself at 10% interest rate. So to avoid that, what a company can do is they can issue callable bonds. So what are these callable bonds? It gives the company a right to redeem the bond before its maturity. So in that particular case, what the company will do, that after the period of 5 years, the company will call the bondholders and tell them that I want to redeem the bond before its maturity. Okay. So what the company is going to do in callable bonds? In callable bonds, the company will redeem the bonds before maturity. Okay. They will redeem it before the maturity. Why will they redeem it? Because they know that, outside the bonds are actually available at, much more cheaper rate. They can raise the funds at much more cheaper rate. So why to bear, higher interest cost? So that is why they will redeem the bonds before its maturity. So these are called as callable bonds. And puttable bonds, your investors, they have a right to actually sell the bonds to the company, okay, before the maturity. So investors have the right to sell the bonds. So apparently what happens is, here the company has the right that they can redeem the bonds before the maturity. Your investors, they have a right to redeem the bonds with the company, okay, before the maturity. So apparently what happens is that if suppose the bondholder thinks that right now the interest rate is very less for this particular company, so let us invest in these bonds, we will see later on. Now after 5 years, they find a good investment opportunity where there is another company, which is offering a higher interest rate. So in case of puttable bonds, what happens is that the investor will go to the company and tell the company, listen, we want to execute the right to sell this bond to you, and you give me the funds back so that I can invest somewhere else. So these are called as puttable bonds. So very simple. Under callable bonds, who has the right to redeem the bond before the maturity? Company. Under puttable bonds, who has a right to sell these bonds? So it's the investor before its maturity. Okay. Now, what are the various features of other different types of bonds? Now, this is something which I want you all to understand very thoroughly, because institute asks you questions based on these different types of bonds. Okay. Now, explaining you in very simple terminology. First one is foreign currency convertible bond, FCCB. Foreign currency convertible bond. Now, the name of the bond is what? These bonds will be issued in foreign currency. Point number one, this is the first feature. And it will be converted into equity shares after some period of time. So these are called as foreign currency convertible bonds. So first point is what? These bonds will be issued in foreign currency. Second, after some period of time, it can be converted into equity share. Okay. So let's say, for example, if I am the company and I want to issue bonds outside India, I can issue it in foreign currency. Yes. Now, the people who have invested in my particular company, I want to make them equity shareholders. Then in that particular case, the second point is that when I will be converting those bonds into equity shares after some period of time. Okay. Of course, the interest will also be paid in the foreign currency, and these bonds are usually issued at a lower interest rates. Okay. So these are some of the features of FCCB. So example, Tata Motors can issue FCCB. Based on that, it can acquire funds which can be used for the purpose of expansion and growth. Okay. Plain vanilla bond. Now, what is a plain vanilla bond? It will not have any features. That's why it's called as plain vanilla bond. Now, when you go to have an ice cream, vanilla ice cream, can I say it does not have any, apart from vanilla flavor, that's the only thing which is there in an ice cream. But if suppose you go for hazelnut, if you go for choco chips, so now in that particular case, there are multiple options which are available. I'm not a big ice cream fan, but just, different types of ice creams where different features are there. Your plain vanilla bond, simple type of a bond. It's called as a plain vanilla bond without any feature. Fixed rate of interest will be given. At the time of redemption, you will get your money back. That is called as plain vanilla bond. Okay. So no options are available. Okay. It's a coupon bearing bond. Fixed rate of interest and fixed redemption. Okay. So FCCB is clear. Plain vanilla bond is clear. Then what is convertible? Floating rate notes. Now, what are these floating rate notes? Now, these are equivalent to your FCCB. Okay. Now, what happens in a floating rate notes? These notes, okay, are issued by the company. These notes are issued by the company. Now, where the rate of interest is very low, but this rate matches with whatever is the existing interest rate which is given to you. So basically, it's like a floating interest rate. Now, the basic purpose of this notes is it will be converted back to FCCB bond after some period of time. Okay. So is the floating rate note going to be converted into a FCCB bond? Yes or no? Yes. Or it can be converted into bond? Yes or no? Yes, sir. So a convertible floating rate note, okay, it has an option to be converted into a long-term debt security. Okay, so what is this? See, floating rate notes. Let's say, for example, a company issues a floating rate note for a period of, let's say, 3 years. Okay, and after 3 years it can be converted back into the debt of the company, okay, for the period of 10 years, where the rate of interest will be fixed. Okay, now for the period of 3 years, this floating rate notes will have the interest rates at par with whatever is the market interest rates. Okay, so the feature is what? Floating rate, it's a note. So that's why this note either has to be what? Redeemed or getting it converted into a bond. So here it will be converted into what? It has an option to convert it into a long-term debt security. So it can be redeemed also, or it can be converted into a long-term debt security also. Okay. And whenever there will be a change in the interest rates in the market, then this floating interest rate is also going to change. Okay. Now, this long-term debt security then can be sold in the market and earn any profits. But capital gain is not applicable to FRN. So this is one of the advantage of the floating rate notes. So once again, I'm repeating, these are the notes or the financial instruments which are being issued initially to mark with the interest rate which is going on in the market. Okay, so that's why it's called as a floating rate note. Okay, point number 1. Point number 2, you have to understand that it will be converted into a long-term debt security in future at a fixed interest rate. Okay, so whatever are the changes which is happening in the market, all those changes, this floating rate note, you are going to get the interest based on that. Okay, no capital gain tax applicable here. Okay, then there is something which is called as drop lock bond. So what is drop lock bond? As the name only suggests, drop lock, it means that if the interest rate falls beyond a particular limit, you are going to get your fixed interest based on the terms and conditions. So that is called as drop lock. So suppose, for example, if it's a floating rate bond, so obviously 10% is the overall market interest rate which is going on. You are going to get 10% on your investment. Suppose it becomes 12%, you will be getting 12%. But suppose it becomes 8%, you will be getting 8%. But now if suppose the interest rate falls 5%, now in drop lock bond, they will have a fixed nature, fixed rate of interest. Suppose if it falls below 6%, you will still get 6% rate. So that is called as drop lock bond. So if suppose the interest rate in the market falls below 6%, will you get 5% or will you continue to get 6%? You will continue to get 6%. So just imagine like this. The floating rate bond would be automatically converted into fixed rate bond if the interest rate falls below the predetermined period. The new fixed rate still stays till the drop lock bond reaches its maturity. Okay, so this new fixed rate 6%, now it remains the fixed, till it reaches the maturity. Okay. The difference between convertible floating rate note and drop lock bond is that the former is a long option structure and the latter one is a short option structure. So here we are going to get the fixed rate of interest, etc. That is something which you have to understand in the drop lock bond. Okay. So what are the features in a drop lock bond? It's a floating rate note only. Okay. But in drop lock bond, if the interest rate falls below pre-decide limit, then in that particular case, a fixed rate of interest will be applicable to you. And that will continue till the time you get converted yourself into a long-term debt security. Okay. Then there is something which is called as your variable rate demand obligation, VRDOs. Okay. Now variable rate demand obligation, what does this mean? It is again a normal floating rate note. Okay. So as this was also a floating rate note, convertible, this was also a drop lock bond, was also a floating rate note. In the same way, your VRDO is also a floating rate note with a nominal maturity. Okay. The holder of a floating rate note can sell the obligation back to the trustee with accrued interest. So in floating rate note, what happens is that I can go to the person who have issued this note to me and sell it back, redeem it back along with whatever was the accrued interest till now. Suppose you have purchased one floating rate note from me where it will be applicable, let's say for example, for the period of 3 years. But after 1 year, you can come to me and sell these bonds back to me and I will give you interest accrued on it as well as the principal amount. So that is called as variable rate demand obligation. Okay. And it gives an investor option to exit. So it is more liquid as compared to the FRN. Then what is a yield curve note? So yield curve note, it means that whatever is the changes in the market conditions and the impact on yield, you are going to get the benefit of the same. So basically what happens is, let's say for example, you have invested in a note. So that's a financial instrument. That's a security in which you have made an investment. But what is the returns which is available to you? So in this particular case, the returns is available in the form of yield curve. It means that if suppose the yield increases when the present interest rate declines, it means that if suppose, for example, you have invested in a yield curve note when the market interest rate was 10%. So in market, people were investing at 10% interest rate, and suppose you have invested in A Limited's bonds, A Limited's yield curve notes, which is also offering 10%. Okay. Now, if suppose the market interest rate falls to 9%, so now in market, the interest rate falls to 9%. In this particular case, when in the market, the interest rate falls to 9%, but your bond is offering 10% rate, in this particular case, the yield of this bond increases. So the returns of this bond increases. Why? Why does it increase? Because your bond is offering more interest as compared to whatever is the market interest rates. So that is called as yield curve note. Okay. So when market interest rates are going to fall, then your bond will offer a higher, when the market interest rates are going to decline, then your yield increases. And when the market yield, when the prevailing interest rate increases, suppose this bond is offering 12%, then your yield will fall. Yield decreases when the prevailing interest rates are going to decrease. Okay. So basically yield curve notes are apparently taken for only one particular purpose, that you can protect yourself from the market fluctuations. So very simple concept. Whenever you have purchased a yield curve note, then when the market interest rates falls, then your yield increases. And when the market interest rate increases, your yield falls. Okay. This is the only thing which you have to remember in your yield curve note. Okay. Eurobond. Now, as the name suggests, Eurobond, it doesn't mean that these are euro denominated bonds. No. Eurobonds actually means what? If for example, in a company in India issues a bond in Japan in dollars, it is called as a Eurobond. Okay. So a company in India, when it goes to Japan for the purpose of raising funds, but Japanese people, they don't want to invest in rupee, nor do they want to invest in yen. They want to invest in a stronger currency. So when this Indian company in Japan will issue a bond in dollars, it is called as a Eurobond. Okay. So Indian company issuing bond in Japan in dollars is called as a Eurobond. Okay. So it is not denominated in euros. This is something which you have to understand. Okay. So in bonds, I hope you'll have understood what are callable bonds and what are puttable bonds. And then I taught you about foreign bonds. So what are these foreign bonds? So foreign bonds first had FCCB, which means the bonds can be converted into equity. Second, plain vanilla bonds, simple bonds with same interest rate and redemption at par. Convertible foreign notes, convertible floating rate notes. Now floating rate notes, it's a note, not yet a bond. So it can be converted back to a bond or a debenture, okay, a long-term debt after some period of time. And here the interest rate, because the name only suggests floating rates, so it will be at par with the market. Drop lock bond, it's a type of a FRN, floating rate note. But here, if the interest falls below the particular level, you are going to get a prefixed interest rate. VRDOs, here you have a choice to redeem the bond back to the issuer. So these are usually trustees who issue such kind of notes. So here you can go there and sell them back and get your money. So these are called as VRDOs. And the last, second last one, which is your yield curve notes. In this particular case, if the market interest rate falls, your yield increases. When your market interest rate increases, your yield falls. Euro bonds, it is not a euro denominated bond. But if an Indian company outside India issue a bond in a third currency, it's called as a euro bond. Okay. What are Indian bonds? The first one, masala bonds. So masala bonds is a rupee denominated bond. that an Indian corporate borrowers can use to sell the investors in the overseas market. So when I am in India and I want US investors to invest, and if suppose I issue the bonds in rupees, that's why it's called as a masala bond. Okay, so here it's a rupee denominated bond. It's not a foreign currency denominated bond. Municipal bonds, these are bonds which are issued by the local authorities for the purpose of meeting their obligations. Government or treasury bonds are, as you all are aware, that these are risk-free bonds which are issued by Government of India, RBI, etc. All those things. Okay. So this is not important. Loan from financial institution, all these things are okay. Now, what are these loans from commercial banks? Okay. So now continuing this further, what is the last thing? What is the next thing which we have? And that is nothing but your loan from commercial banks. So now, my dear students, when we are dealing with your loans from commercial banks, so basically, what are the different types of loans which you can take from your commercial banks? It depends upon whether you are taking long term or short term in nature. There can be bank overdrafts, there can be cash credits, etc. and all those things. But first, let us understand a very important concept which is pertaining to your bridge finance. Now, what is this bridge finance? Now, let's say, for example, if I need a loan amounting to rupees 10 lakhs and I need this loan for the period of 5 years. But bank is actually taking some 3 months time to process this loan. Now, from today till the next 3 months, I need that funds, but bank is going to take 3 months time. So what will I do is, for this period of 3 months, I will approach some other bank. I will approach some other financial institutions, and they are going to provide me with a temporary loan for the period of this particular 3 months. And when I get the finance from these institutes, then it is called as a bridge finance. Okay. So as you all can just check, what is bridge finance? It refers to the loans taken by the company, normally from commercial banks, for a short period because of pending disbursement of the loan sanctioned by the financial institutions. Okay. So as I told you that it is going to take, like, let's say 6 months time or 3 months time, or 9 months time for the purpose of disbursement of the loan for the period of 5 years, 6 years, etc. I've got the sanction letter, but it is going to take some time for the purpose of disbursement. So for that much period of time, what should I do? I can go and approach some other financial institutions. I can give them this sanction letter, and based on that, they can help me out with the loan for this short period. So that is called as bridge finance. Okay. Now, bridge loans are normally secured by hypothetical, movable assets, personal guarantees, and demand promissory notes. Okay, so these are also actually financed. These are also secured by such kind of assets. Now let us come to venture capital financing. Okay, now venture capital financing, what does this mean? It refers to financing of a new high risk venture promoted by qualified entrepreneurs who lack experience and funds to give shape to their ideas. Now, my dear students, this is very important. So basically, venture capital financing, as we have understood earlier also, at what stage of business can you go and approach a venture capitalist? So initially what happens is, there is angel financing, right? When the business has just started, or it is at a very early stage and there is a very high risk of uncertainty. Now, when there is moderate and low risk of uncertainty, then in that particular case, we approach venture capitalists. So they are going to invest in the particular company, and these companies are promoted by qualified entrepreneurs. Now, let's say, for example, you have an amazing, brilliant business idea. You have generated some sales and brought your business from highest uncertainty level to moderate uncertainty. So in that particular case, venture capitalists are going to give you funds. Okay, they can invest in the equity of the company. Now, how are they going to finance you? So it is basically an equity finance in the new company. So are they going to subscribe to your equity shares? Yes or no? Yes. And it can be viewed as a long-term investment in growth-oriented scheme. And then apart from providing funds, the investors also provide support in the form of sales strategy and business networking and management expertise, enabling the growth of the entrepreneurs. Okay, so basically, are they going to purchase, or are they going to invest in the equity of the company? Yes or no? Absolutely yes. Okay, so this is how venture capitalists finance, majorly in the form of equity financing. Second, it can also finance by the way of conditional loan. then income note, and participating debenture. Now this can be your theory question, that what are the methods on the basis of which a venture capitalist will finance. So first one is equity financing. As you all know, basic equity, they can invest in the equity, how angel investors also invest in the same way. Okay, but here the equity contribution does not exceed 49% of the total equity capital venture of the particular company. So they are not going to subscribe to more than 49%. So till up to 49% a venture capitalist can invest in the equity of the firm. Okay, so which means what, that the effective control and ownership remains with the entrepreneur. Second is what, your conditional loan. Now what is conditional loan? A conditional loan is repayable in the form of royalty after the venture is able to generate sales. Now what happens is, in this particular case, the most important thing you have to understand is there is no interest, but how much the sales is being incurred by the company, the venture capitalist will get some kind of royalty. So let's say, for example, you have a very brilliant business idea and you are going to manufacture a product and then you are going to sell it. So I give you loan so that you can manufacture the product, and whatever is the sales which is going to happen, I am going to definitely charge you some royalty. So in this particular case, what is going to happen is that if suppose you are going to sell X number of units, then for every 1 unit, I'll be charging you a royalty. Okay. Now this royalty will be between 2 and 15%. So conditional loan does not have any interest. It has royalty. Okay. And some venture capitalists can also, are going to give loans at a very high rate of interest. But basically, the whole purpose of conditional loan is what? That there is going to be royalty on sales. Okay, so we have to remember the word royalty. Okay, and then we have income note. So what is income note? Now this is the hybrid security which combines features of both conventional loan and conditional loan. So here there is interest and royalty both. Okay, so when a venture capitalist is going to provide a loan in a way that you have to give interest also and some royalty also, then it is called as an income note. Okay, so here there is interest as well as there is royalty. Okay, and then what is participating debenture? Now here such securities carries charges in 3 phases. In a startup phase, no interest is charged. Next stage, low rate of interest, and then after that a high rate of interest. So this is called as participating debenture. So as and when the company keeps on growing, the interest will also change. So a venture capitalist is definitely going to invest in a particular company in the form of equities, yes. In the form of conditional loans, yes. But in conditional loans, we have to pay attention that there is going to be royalty on the sales. Third, income notes, which is the combination of royalty as well as interest. And the last one is participating debenture, where there is different types of interest at different levels of growth in the particular company. Okay, but primarily you will always see that venture capitalists invest in the equities of the company, which should not exceed 49%. Okay, now continuing further, what is the concept of debt securitization? Again, an important concept from the examination perspective. Now when we are dealing with your debt securitization, I'll give you one example on the basis of which you'll be able to understand this entire concept. Now let's say, for example, so let us now understand the concept of your debt securitization. Now what happens in a debt securitization? See, securitization is a process in which illiquid assets are pooled into marketable securities that can be sold to the investors. The process leads to creation of financial instruments that represent ownership interest in or secured by segregated income producing asset or pool of assets, and these assets are secured by personal or real property such as automobiles, real estate, etc. Okay, now see, basically the debt securitization in which there is a finance company which sells its existing car loans already given to the borrowers to the SPV, and the SPV which in turns is going to lend the money. Okay, now I'll just explain you this with the help of this example. Now see, listen, pay attention. See, basically what happens is, let's say for example there is a non-banking financial company. Okay, and this non-banking financial company has given, let's say, auto loans. Okay, and then they have given, let's say for example, some personal loans. They have given some mortgage loans. Okay, and on an average the entire loan portfolio is of rupees 100 crores. okay, and they are earning, let's say, interest rate of 10%. Now what happens is that this NBFC company is actually in need of some funds. So what this NBFC company will do, this NBFC company will sell this entire loan portfolio to a special purpose vehicle, and this SPV is going to give then some amount to this NBFC. So basically what happens is 100 crore rupees is required by NBFC. Suppose 90 crore rupees is required by the NBFC. Okay. So what will NBFC do is, NBFC will sell this entire loan portfolio to this special purpose vehicle. So this loan portfolio will be transferred to the special purpose vehicle, and the special purpose vehicle will give some amount to NBFC. Suppose they give 90 crore rupees to NBFC. Okay. Now in this particular case, what will happen is, NBFC got 90 crore rupees today. Yes or no? Of course, yes. Now this special purpose vehicle, why will it do it? So in this particular case, whatever is the interest which this borrowers were supposed to pay to NBFC will now be transferred to the SPV. So basically, SPV is going to earn every year an interest of rupees 10 crores on an average, right? Because 100 crore is a loan portfolio. So 10 crore is the interest which this SPV is going to earn. Now what is going to happen is, when this SPV is going to earn interest at rupees 10 crores, this SPV, how will it arrange its funds? So this SPV can also issue some securities, let's say for example at 8% rate. So investors who wants to actually earn fixed return will subscribe to the securities which are issued by the SPV. Okay. So SPV is going to issue security, and these subscribers are going to subscribe to these kind of securities, and 8% is actually the amount of the interest. You know, this SPV is actually going to give them the interest at the rate of 8%, and they are going to earn the interest at the rate of 10%. So the difference of 2% is nothing but the income which will be earned by the special purpose vehicle. Okay. So now if you just see everyone's advantage, everyone's purpose is being met. How? Because those who actually want to earn fixed interest, they are going to subscribe to the securities issued by the SPVs, right? So they are going to get their 8% fixed interest, and this SPV is going to get the funds of 90 crores from these kind of subscribers. Once they get 90 crore rupees, what are they going to do with this 90 crore rupees? They are going to make the payment to this NBFC. So NBFC also wanted 90 crore rupees. They have got this 90 crore rupees, right? And then whatever is the interest which these borrowers, original borrowers, the loan portfolio of 100 crores, these borrowers, whatever interest they were supposed to pay to NBFC, now that interest will be transferred to the SPV. So SPV's interest income will be what? Around 10 crores, that is 100 crores, 10%. And what is their interest expense? That is approximately, 90 crores, and on that 8%. Okay. So somewhere around 7.2 crores. Okay. And the difference will be what? This income for the special purpose vehicle. Okay. So this type of business is called as debt securitization. And in this particular case, this NBFC have got rid of the assets or the loan portfolio from their balance sheet. So as you all can read, the process of debt securitization helps the finance company to raise the funds and get the loans off its balance sheet. Okay. So in debt securitization, just understand one very simple concept. There is a finance company or a NBFC company. Then there is a special purpose vehicle. A finance company has a loan portfolio. That loan portfolio will be sold to the special purpose vehicle. And how will the SPV arrange for the funds? By issuing marketable securities, and then people will subscribe to this marketable securities. They are going to get the funds. That funds will be transferred to the NBFC, right? And then whatever is the interest which NBFC was supposed to earn, now will be eventually earned by whom? It will be eventually earned by your it will be eventually earned by your special purpose vehicle, and then the difference amount of both the things will be treated as the profits. Okay, so that is something which we have understood in your debt securitization. Fine, let's continue this further now. What is the next concept? The next concept is pertaining to your lease financing. Now, as you all are aware that there are two main types of lease, your operating lease and your financial lease. Now, when it comes to operating lease, what are the basic features? Number one, the ownership right of the asset continues to remain with the lessor. Okay, so what is operating lease? You just enjoy what is going to be, the rental income from the lessee. Okay, so suppose you are the lessor. So in this particular case, what is going to happen is, let's say, for example, you have a particular house and you give it on rental basis. So that will be treated. You have a particular commercial shop which you are giving it on rental basis. So basically what is happening is that this particular type of transaction is called as an operating lease. So in operating lease, what happens is that the right of ownership continues to remain with the lessor. Okay. Now the lessee gives a fixed periodic lease rentals, okay, to the lessor, and whatever is going to happen, to the maintenance, repairs, etc. of the asset, all this will be borne by the lessor himself. Okay. And the lease period is generally short. Okay. So basic rental agreements, we will treat it that as an operating lease. So for example, you have a particular car and you want to give it on rental basis for the period of, let's say, 2 years. So this type of transaction will be treated as your operating lease. Whatever is your repairs, maintenance, etc., all will be borne by the lessor, who is the owner of the car. Depreciation and all those expenses will be borne by the lessor. Okay. Second, now what is financial lease? Now financial lease means what? It is a long term and non-cancelable. Okay, that is, the lessee cannot terminate the lease agreement subsequently. Now in this particular case, the basic nature is what? It should be long term in nature. Okay. Now in financial lease, what happens is the period of the lease is generally the full economic life of the leased asset. So let's say, for example, if the car is going to have a life of, let's say, for example, 10 years, then the entire agreement is going to be for the period of 10 years. Okay. So here it should be from the long-term perspective, and the lessee has to bear the insurance, maintenance and other related costs. Now, because if I am giving you this particular asset for the period of 10 years, so over the period of 10 years, whatever is going to be the repairs, maintenance cost, etc., all this will be borne by whom? It will be borne by the lessee. Okay, the person who has taken the asset. Okay. And it is also called as your capital lease, okay, which is nothing but loan in disguise. Okay. Now, what is the basic difference between financial lease and operating lease? The risk and reward incident to the ownership is available to the lessee, and here everything is with the lessor itself. The lessee bears the risk of obsolescence, means whatever is the asset, if suppose it's going to be outdated, then it's the lessee who's going to face the risk. But in operating leverage, in operating lease, it's always the lessor. Okay. So basically, the lessor is interested in his rentals and not in the asset. So he's not concerned because it's in long-term nature. And basically, we have given this particular asset on lease throughout its economic life. So he's not concerned with whatever is going to happen to the asset. But here, what is happening is the lessor does not have any difficulty in leasing the same asset to other willing lessee. Okay, so he can give it to other person as well. So for after the period of 2 years, he can give this car to some other person as well. But here in financial lease, the entire asset is being given to the lessee for the entire economic life of that particular asset. Okay, the lessor enters into a transaction only as a financer. Okay, so it's something like this, that I buy this car, okay, and I give it to you, and whatever rental which I'm charging it from you, that is over the period of 10 years. So I'm only financing your car, and then you are only going to bear the repairs, maintenance, etc. Okay, here the lessor bears, whatever is the repairs cost, etc., maintenance and all. Okay, the lease is usually full payout. Okay, single lease repays the cost of the asset, and here it is the lessor expects the lease of the over the several uses. Okay, so basically what happens is that here the lessor, okay, in financial lease, what the lessor is going to expect is, if suppose the cost of the car is 10 crores, is 10 lakhs, then from the lessee in the financial lease, entire 10 lakh is expected. But here what is going to happen is that this particular lessor, from one customer, he will try to expect 2 lakh rupees as rental, from second customer 3 lakh rupees. So over the period of 10 years, different types of assets will be taken into consideration, and based on that, you are going to get the particular amount by the way of lease. Okay. Now continuing this further, what are the other types of leases? Okay, so there is something which is called as sale and lease back. Okay, so let us understand this. So in case of your sale and lease back, okay, here what is going to happen is a very simple transaction. Suppose you are the owner of a particular house. Okay, now what is happening is that you sell this house to me and I lease this particular house back to you. So that is called as sale and lease back. Okay, so let's say for example you are in need of funds and you want to get rid of this particular property. Okay, but you also want to stay in this property and I'm just an investor. So what happens is that you sell this house to me, I am going to give you the payment. Okay, and then in that particular case, every year you are going to enjoy the benefits of this property. You are going to use it and you are going to give me rent. So that is called as sales and lease back. Okay, so basically what happens is under this type, the owner sells the assets to a party who in turns lease back the same asset to the owner in consideration of the lease rentals. Okay, so it continues, you are going to enjoy this particular benefits of the property. Okay, the second is called as your leverage lease. Now what is leverage lease? So in leverage lease, what happens is in this particular case, a third party is involved besides the lessor and the lessee, and the lessor borrows a part of the purchase cost. Okay, say 80% of the assets from the third party, that is the lender, and the assets of purchase is held as a security against the loan. The lender is paid off from the lease rentals directly by the lessee, and the surplus after meeting the claims of the lender goes to the lessor. Okay, now I've just written one small example for this. Now let's say for example there is a solar company. Now this solar company actually wants to install a solar plant. Okay, and the cost of the solar plant is, let's say for example 100 crores. Okay, now this solar company let's say for example it wants to install a solar plant. So what it's going to do is, to get this particular plant, okay, it will approach, let's say for example, an investment bank. Okay, now this bank, what is going to do is they are going to lease this particular solar plant to this solar company. Okay, and now this plant will entirely be financed by this lender. So a lender is going to, this particular lender is going to give, let's say for example 80 crores for this particular plant. Okay, 20 crore is being by this particular investment bank, and this 100 crore plant is given to the solar company. Now this solar company is going to give some rent which will first directly go to the lender, and any surplus that will be transferred to the investment bank. So I'll just explain you this with the help of this example. So let's say for example there is a company which wants to install a plant and machinery worth rupees 100 crores. Okay, but they definitely don't have funds. So what happens is there is one investment banking company, okay, and there is one lender. Okay, now what happens is, so this investment banking company, now what have they told is, okay, listen, we are ready to finance this 100 crores. Okay, and you have to give them rentals. Okay, now this investment banking company, they will approach one lender who is going to finance, let's say 80% of this particular asset cost. So 80 crores will be financed by this lender, 20% will be financed by this investment banking company itself. Okay, so this entire 100 crore plant and machinery will be helped to be set up in this particular company. Now this company will definitely give some rent or lease payments. Now these lease payments will first be transferred to this particular lender. It will be first transferred to this particular lender, and lender will recover first its interest, and whatever is over and above, because this lender has financed 80 crore rupees, right? So that will be, they are going to recover their interest part and whatever is the obligation which is being mentioned, and any surplus will then be transferred to this investment banking company. Okay, now let us read this. See, under this lease, a third party is involved besides lessor and lessee. So let's say for example in our example, this is a lessor, okay, and this is a lessee. Now what happens is, a third party is also involved. So who is the third party? Here the third party is a lender. Okay. Now continuing further, the lessor borrows a part of the purchase cost, say 80% of the asset from a third party, that is lender. So when this particular lessor is going to buy this asset for 100 crore rupees, 80% will be financed by this particular lender, 20% will be its own contribution. Okay, continuing further. And the asset so purchase is held by the security as a loan. Now, the lender is paid off from the lease rentals directly by the lessee, and surplus will go back to the lessor. Okay, and the lessor is entitled to claim depreciation. So it is the lessor who's going to claim the depreciation for the same. Okay, lender is just one type of a financer. Okay, so in your leverage lease, is there going to be any lender which will be involved, any third party which will be involved? Yes or no? Yes, sir. So there will be a lessor, lessee, and a third party. So let's say, for example, if I'm a lessor and I will purchase this particular plant and machinery and give it on rental to the lessee. Lessee will give, this rentals, but first the lender will take its cut and balance part will be transferred back to the lessor. Okay, so this is something which happens in the leverage lease. For this, we also open something which is called as an escrow account. Okay. The next type is your sales aid lease. Now, what is going to happen in this particular part? Under this lease contract, the lessor enters into a tie-up with a manufacturer for marketing the latter's product through its own leasing operations. It is called a sales aid lease. Okay. In consideration of the aid in sales, the manufacturer may grant either a credit or a commission to the lessor, and thus the lessor earns from both sources, that is lessee as well as the manufacturer. Now in sales aid lease, what happens is the lessor enters into a tie-up with a manufacturer for marketing the latter's product. So basically what happens is, let's say for example, Xerox companies, they manufacture these big machineries or they manufacture these Xerox products which is sold to the stationery shops, etc. So let's say for example Xerox company, they are the manufacturers of these Xerox machines. Okay, now these machines first will be sold to the shops. Okay, but the shop people, the stationery shops, they will not have funds or money available to buy this particular machine. So that is how a lessor will come into the picture. Okay, so Xerox company are going to manufacture these machines, but this lessor will go to this particular shops and then they will give this particular machines on lease basis to this particular shops. Now these shops will give some rentals to this particular lessor. So are these lessor going to earn by the way of lease or rent from this particular shops? Yes or no? Yes, sir. But how much quantity if they are selling? If suppose this lessor is selling this particular Xerox machines to multiple shops, so this lessor will also ask for some commission from the Xerox companies. So the lessor is going to earn from two sources. One is by the way of commission and second is by the way of rentals from this particular shop. So this is called as your sales aid lease. So in sales aid lease, unlike leverage lease, in sales aid lease what happens is the lessor promotes this manufacturer products. So they're going to go to the stationery shops and they're going to promote the manufacturer's product and they're going to tell that case, listen, this Xerox company machines are amazing. So in this stationery shop, you should definitely install this machine. So the stationery shop owner will tell that I don't have the funds. It's okay. The lessor will tell I am going to finance it. Okay. And you have to give me lease rentals. And how much quantity they are going to sell, Xerox company will also give them some commission. So that is called as your sales aid lease. Okay. Then there is close-ended and open-ended. So in close-ended lease, the assets gets transferred to the lessor at the end of the lease. So basically operating lease types. Okay. So that is called as your close-ended, where the assets are transferred back to the lessor. And of course, under open-ended, what happens is that lessee has the option of purchasing the asset at the end of the lease period. So once the lease period is going to be over, the lessee can purchase the asset back from the lessor. So that is called as close-ended and open-ended lease. Okay. Continuing further, now we have something which is called as your short-term sources of finance. Now, what are the different short-term sources of finance? Now, let us understand this. The first one is called as your trade credit. Now, what is this trade credit? Now, this is generally the credit which is actually being offered by the supplier. So that is called as your trade credit. So very simple concept. So let's say, for example, if suppose you go and buy the goods on credit basis, so that is actually called as your trade credit. It's a short-term source. What is your accrued expenses? Okay, so that is also, let's say, for example, you go to, let's say, for example, there is an expense which you incur, but you have to make the payment after some period of time. So that is called as accrued expenses. So trade credit is given by whom? Suppliers, right? And this is other than creditors. Okay, so that's why your creditors will be your trade credit. So whenever you are going to get, you're going to buy the goods and you're going to get a credit of 15 to 90 days. So this is called as a short-term source of finance. Okay. Accrued expenses means what? That you are going to make the payment after some period of time, outstanding expenses. So that is also one type of source of finance. Okay. Then we have something which is called as advance from customers. So that is also short-term finance because you are going to get the funds right now, immediately. Then what is your commercial paper? So commercial paper means what? This is also unsecured money market instrument in the form of promissory note. Now, usually these commercial papers are issued at discount and they are redeemed at par. Okay. So a commercial paper, let's say, for example, it is, they are actually issued in the denomination of 5 lakh rupees. So let's say, for example, 5 lakh rupees is the face value of a commercial paper. Let's say, for example, they are issued at 4,20,000. Okay. And these are 90 days commercial papers. Okay. So basically, for example, if I am in need of, 4,20,000 right now, then what will I do is I will issue one commercial paper at 4,20,000. And then after the period of 90 days, I will redeem it at 5 lakh rupees. So definitely you are going to earn, 80,000 rupees. And I'm going to meet my short-term finance with the help of commercial papers. Okay. So even financial institutions like NBFC companies, etc., they are also allowed to issue commercial papers. But these commercial papers can also be interest bearing as well. Okay. But, practically what happens is that we will issue it at discount and redeem it at par. And, this commercial papers should actually be, rated by CRISIL, ICRA, etc. So there should be a credit rating which should be attached to it. See, because practically what happens is that you and me, we are not going to go and purchase these commercial papers, but a mutual fund, who are debt oriented. So basically they are going to raise the money from, many investors, but they don't want to invest in the equities of the company, but they are then going to invest in such kind of commercial papers, certificate of deposits, treasury bills, etc. So these mutual funds, they are going to search for different types of commercial papers which are there in the market. Reliance commercial papers, Tata commercial papers. So when these companies are in short-term need, they will issue commercial papers. It is the mutual fund who's going to subscribe to it. But all these commercial papers has to be rated by different credit rating agencies so that the risk level can be determined. Okay. Then treasury bills, they are issued by the government. Then there are certificate of deposits. Okay. These are also issued by a particular company. Okay. Just like FD, these are certificate of deposits. Okay. And then there are bank advances. Now, bank advances is in the nature of short-term loans. So as I told you, short-term loans is for a shorter period of time, maybe less than, 3 years or 1 year, etc. So you can treat this as a short-term loan. Overdraft is always given on the current account. Now, what is clean overdraft? So clean overdraft means it requests for clean advances only from the parties which are financially sound and having a reputation for their integrity. So let's say, for example, you have a very good credit score, and when you go to the bank for obtaining an overdraft, so that is called as your clean overdraft. Okay. So there is no such security which is taken apart from the personal security of the borrower. Okay. So that is called as your clean overdraft. Cash credits, this is also similar to your bank overdrafts only. Okay. And your interest is not charged on the full amount, but only the amount which is actually availed by the particular customer. And these are provided against tradable goods, and there is going to be pledge or hypothecation. So apparently what happens is cash credit facilities is being given by taking these goods as a security. So there is a hypothecation which is involved there, and based on that, what happens is that the loan etc is being given and the interest is being charged accordingly. Okay, so sometimes overdrafts can be unsecured, okay, but cash credits are generally secured by the way of pledge against this kind of goods etc. So if suppose you have stock worth rupees 1 crore, so you can obtain a cash credit against that particular stock as well. Okay, then there is something which is called as advance against goods, okay, bills purchased discounted etc. And then there is financing of export trades by the bank. So before we continue with that, so till now, what are the short-term sources of finance? So trade credit till now is given by the creditors. Then outstanding expenses, this is also short-term finance. When we take advance from the customers, that's how also you are financing yourself. Commercial papers, instruments which are being issued sometimes at discount, matured at par, with 5 lakh rupees of your face value denomination. Okay, and then treasury bills by the governments. Okay, then certificate of deposits, just like FDs, but here for a shorter time period, companies are going to issue such kind of certificate of deposits to finance itself. Then in your bank advances, we have something which is called as short-term loans, overdraft, clean overdraft, cash credits. Okay, and then what are the advance against goods and bills purchased discounted etc. Now what, of course, bills discounted also is nothing but one of the way where you take the finance from the bank, right? So you discount the bill with the bank, and then the amount which you take it, that is called as your bill discounting, and you finance yourself from the bank in some way or the other. Now financing of export trade by banks. Okay, now how does an how does an exporter meet its short-term fund requirement? That is something which we are going to learn in this particular part. Okay, now here we will understand this with the help of two important aspects, and that is nothing but your pre-shipment, before shipment of goods, and after shipment of goods. Now let's say, for example, what happens is the commercial bank provides short-term export finance mainly by the way of pre and post shipment credit. Okay, these are the two important categories which you have to understand. So basically, what is this point relating to? That you are actually an exporter and you need funds. Okay, so basically you are going to approach to the bank and take short-term funds. Okay, so what is given to you, just check. Short-term export finance mainly by the way of pre and post shipments, and export finance is granted in rupee as well as in foreign currency. So for example, you are exporting, let's say for example, cars outside India, and you need funds. So you are an exporter, so you can approach to the bank and you can get short-term export finance from this bank into two categories: pre-shipment and post-shipment. Okay, pre-shipment means what? Before exporting the goods, and post-shipment means after exporting the goods. Okay, and you can get the loans in your home currency also and in your foreign currency also. Okay, so there are lots of benefits which are given to these kind of exporters, so that these exporters can export more goods outside the country. Okay, now see, there is no limit which has been given by RBI to the bank to such kind of exporters. Okay, so that's why you have seen that there are so many scams which has happened where these diamond exporters, they have taken advantage of this situation. They have taken loans from these banks, but they are unable to repay it. Okay, so many exporters have defaulted in repayment of such kind of loans to the banks. Okay, now what is this pre-shipment finance? Now pre-shipment means what? Before, now let's say for example, if I'm a manufacturer and I want to export goods, but because I'm a manufacturer and I want to export goods, there are some costs which will be involved before exporting the goods, which involves cost manufacturing the product, packing, and then logistics, etc. So all this will require some type of cost, and to finance that cost, we can definitely approach these banks, and banks can provide us with a short-term finance. Okay, so whatever is the packing credit facility, packing credits and advance extended by the banks to an exporter for the purpose of buying, manufacturing, processing, etc. Okay, so this is called as pre-shipment finance. Okay, before the goods have been sold, before that, okay, whatever is the cost incurred, we can take finance to bear that cost as well. Okay. Now, what are the types of packing credits? So there is something which is called as clean packing credit, packing credit against hypothecation of goods, packing credit against pledge of goods, ECGC guarantee, and forward exchange contract. Okay. Now, one by one, we will understand this. Okay. Now see, what is clean packing credit? This is an advance made by available to an exporter only on the production of a firm export order or a letter of credit without exercising any charge or control over the raw material finished goods. It is a clean type of export advance, and each proposal is weighed according to the particular requirements of trade and credit worthiness of the exporter. A suitable margin has to be maintained, and also export credit guarantee corporation cover should be obtained by the bank. So basically, based on the firm export order. So clean packing credit means what? Let's say, for example, you are a manufacturer and you have got an order from someone in US. Based on that order, you go to the bank and ask for loan. That will be called as your clean packing credit. Okay, very simple. So you are able to justify this to the bank that I want this finance because I want to manufacture this X quantity, and why I want to manufacture this is because I've obtained order from from a customer in US. So based on that, when you're going to get an advance, that will be called as your clean packing credit. This is the first point. Second, packing credit against hypothecation of goods. Now in this particular case, you have already manufactured the goods and you want some bank overdraft or credit. So you will hypothecate that. It means that you're going to pledge that, and then against that, when you're going to get the loan, so that will be termed as packing credit against hypothecation of goods. Okay. So the first type is what? Very simple. Against your order, you are going to receive some money. Okay. Okay, because you want to process that order, so you need funds. So you're going to go to the bank and ask for funds. Second is you've already manufactured it. You have goods, but you still need money. So in that particular case, the bank is going to hypothecate that goods and you are going to get some money. And then packing credit against pledge of goods. Same, very similar to hypothecation of goods, but here it is made on certain terms and conditions where the exportable finished goods are pledged to the banks with the approved clearing agents who will ship the same from time to time as required by the exporter. So there are certain formalities which is involved here, but the whole thing is what? If you're against the goods, you are going to get some funds. Then there is some guarantee which will be given. Okay, so any loan given to the exporter for the manufacture process, etc., for the export against a firm order qualifies for packing, and here the guarantee is issued by Export Credit Guarantee Corporation. So when you are going to get some funds based on some guarantee. Now let's say, for example, I'm ECGC, okay, and you are an exporter, and I know your credibility, and based on your credibility, I tell Punjab National Bank to give you finance. So in this particular case, what has happened is, have you financed yourself under a guarantee? Yes or no? Yes, sir. So I know that you're a very authenticated exporter, and you have always exported goods. You have received money from your foreign customers. And now in this particular case, what happens is that when you want some funds, you go to the bank. Bank does not know about your credentials. So you approach and take guarantee from me. And when I give the guarantee to PNB, PNB will definitely give you some loan. So that is how ECGC guarantee works. Forward exchange contract. Now that apparently means what? That you go to the bank and you hedge yourself against whatever is the receivable. So let's say, for example, you are an exporter A. You have sold goods to B, who is in US. Now B is going to make the payment in dollars. So you want to convert this dollars to rupees, but you don't know what is going to be your exchange rate. So when you go to the bank and fix up the exchange rate that after 3 months I will come with dollars and you are supposed to give me $1 at rupees 95. So in this particular case, this is called as a forward contract. Okay, forward exchange contract. So this is all regarding your pre-shipment. Okay, so these are the types of packing credit. So clean packing against hypothecation, against pledge of goods, against guarantee, and forward exchange contract. Okay. Now what is your post-shipment finance? Now post-shipment means what? That after the goods have been exported, then how can you get the finance from the banks from short-term perspective? So first is what? Purchase or discounting export bills. So based on the export bills, you know that this much amount is supposed to be received from Mr. B, but you need the funds right now. So you can go to the bank, discount that bill and receive the money. Okay. So I have sold goods to someone in US, and based on that bill, I know that $1 lakh I'm going to receive after 3 months. I will go, and goods have already been exported. So I will take that bill, go to the bank and get some funds based against that particular bill. Okay. Again, guarantee takes place here. Similar concept. Then advance against export bills. So obviously, I will tell my customer, give me some advance. I've already exported the goods from to you. So based on that, any advance received, that is against post shipment. And then duty drawbacks, cash subsidy, etc. So these are different types of schemes of the government based on which you are going to get some funds. Okay. So to finance the export losses sustained by the exporters, bank advance against the duty drawback, cash subsidy receivable by them against the export performance. So based on that, you are going to get some duty drawback. It means what? That whatever is the export duty which has been levied to you, some part will be refunded back. So that will be called as your duty drawback. Okay. So all these are nothing but post shipment. Okay. So these are short-term loans which is exclusively provided only to the export customers. Okay. So other facilities not that important. Now what is this intercorporate deposits, ICDs? So from one bank, one company to another company. Now let's say for example, Tata's to Reliance, or let's say for example, NBFCs, they give loans to big corporates or corporations. So in that particular case, it will be called as your intercorporate deposits. Okay, between the two companies, if the loans are being given, those are called as ICDs. Certificate of deposits, we have already discussed earlier. You know, here also it is just type of a deposit certificate where the fixed rate of interest will be charged for a particular tenure. Okay. Then there is public deposits where the companies can issue these kind of deposits, and let's say for example, Shriram Transport. Okay. Very common in your public deposits that they are going to issue securities or this deposit certificates, and people like you and me who wants to earn fixed interest. So, but their interest rate is slightly higher than the bank FD interest rates. So then we are going to, approach them. We are going to subscribe to their deposit certificates, and they are going to give us the interest, and that's how they are going to finance themselves. So that is called as your public deposits. Okay. But here the most important part is it should not be exceeding more than 35% of the paid up capital and reserves. Okay. And the tenure is maximum 3 years. Okay. So this is pertaining to your finance from your banks, etc. So short-term sources of finance. So these are the different types of points which we have understood. Okay. Pertaining to your short-term finance. And then let us continue this further to other sources of financing. Okay. Now what is this seed capital assistance? So other sources of financing. Now this can come as a short 4-mark question. What is seed capital? What is internal cash accruals, unsecured loans, deferred payment guarantees, capital incentives, deep discount bonds, security promise premium notes, etc. So I'll just explain you in short, all these different types of other sources of financing. So the first one is seed capital assistance. Now this scheme is designed by IDBI. Okay. So when it comes to seed capital assistance, it is designed by which bank? IDBI. For professionally or technically qualified entrepreneurs and or person possessing relevant experience, skills and entrepreneurial traits but lack adequate financial resources. So you are, as a chartered accountant, have a brilliant business idea but no funds, then you can take help of seed capital assistance, okay, from IDBI. So you have to give the project to them, they will approve it, and then they are going to give you funds, okay. But you have to be eligible with that, okay, under the scheme, whatever is being specified. Now this seed capital assistance is interest free but carries a service charge of 1% per annum for the first 5 years. So it's a very lucrative, very easy, the best way. So where if you have a brilliant business idea, you are a chartered accountant, brilliant business idea, but you don't know that how are you going to, you don't know how are you going to finance yourself. So in that particular case, you can approach IDBI. IDBI can give you this particular finance of the project at 1% service charge and something like that. Okay. And IDBI will have an option to charge the interest at the rates which are determined by IDBI. So that is completely optional. Okay. So that is the first type. Then the second one is internal cash accruals. So whatever is the cash which is generated by the company, but they are, using it for the purpose of expansion and growth. So we call that as internal cash accruals. Now, what are these unsecured loans? So as you all are aware that whenever, you don't have any security which is to be kept, but here the interest rate is very high, the risk is very high. Okay. So that will be treated as your unsecured loans. Deferred payment guarantee. Many a time, suppliers of the machine provide deferred credit facility under which payment for the purchase of the machinery can be over a period of time. So let's say, for example, if I have manufactured a machine, I'm selling this to my customer and I'm not taking the payment immediately, but I'm taking the payment after some period of time. I'm deferring this payment. So that is actually called as your deferred payment guarantee. Okay. And then there is something called as capital incentives. So here these kind of incentives and grants are given for setting up the project in the backward area. Okay. So these are called as your capital incentives. Okay. So this is lump sum subsidy which is given by the government. So that is also your other source of finance. Deep discount bonds. These are issued at discount and redeemed at par. So let's say, for example, if suppose I issue a bond whose face value is 100 rupees, but I am issuing this, let's say, for example, at 20 rupees or at, let's say, 30 rupees or 40 rupees. So this is called as your deep discount bonds, and this will be redeemed at par. Okay. There is no interest payment during the lock-in period, and that's why these are also very similar to your zero coupon bonds. Secured premium notes. So this is issued along with a detachable warrant and is redeemable for, let's say, 4 to 7 years. Okay. And the conversion of detachable warrant into equity shares will have to be done within a time period. So secured premium notes, these are in the nature of share warrants, and these share warrants gets converted into equity shares after some period of time. Okay. Zero interest fully convertible debentures. Now this is one type in which, this debentures gets converted into your equity shares after some period of time. Zero coupon bonds, again, this is very similar to your deep discount bonds. Then we have something which is called as option bonds, where there was callable, puttable, etc. Okay. Inflation bonds, these are the bonds whose interest is reflected with the inflation rates. If the inflation rate keeps on changing, then this bonds will also give you different types of interest. Very similar to floating rate bonds, where the interest rate keeps on fluctuating, but here the interest rate is actually pegged to some, fixed benchmark rate. So let's say, for example, we have this as, you all are aware about something which is called as repo rate. So repo rate plus, let's say, 3%. So this is the rate of the floating rate bonds. So let's say, for example, if the repo rate currently is 7%, so what is going to be your bond interest rate? 10%. Now after a quarter, if repo rate is 6%, then in this particular case, the bond will also bear an interest rate of 9%. Okay. So these are called as floating rate bonds. Okay. Now, what is this international financing? Okay. So here, the essence of financial management is to raise and utilize the funds raised effectively. Now, there are various avenues for the organization to raise the funds either through internal or external sources, and the sources of external financing includes commercial banks. So now, how can you raise the funds outside your country? So from commercial banks, development banks, discounting of trade bills, international agencies, international capital markets, so these are the ways on the basis of which you can raise the funds from outside. So let's say, for example, an Indian bank going to Citibank, US, and raising funds. So then we are ensuring that we are taking the funds from outside India. Okay. And from outside India, when we are taking the funds, will it be forming part of international financing? Yes or no? Yes, sir. Okay. Now here the most important part will be treated as the financial instruments. Now what are the financial instruments which you can issue outside your country and raise your funds? Okay. So these are different types of financial instruments which we are going to right now just go through it. Okay. Now see. First, what is given to you? External commercial borrowings. Now, external commercial borrowings refer to loans. Okay. in the form of bank loans, buyer's credit, supplier's credit, etc., which can have floating rate notes, fixed rate bonds, availed from a non-resident lender with a minimum average maturity of 3 years. Borrowers can raise ECBs through internationally recognized sources like international banks, international capital markets, multilateral financial institutions, suppliers, foreign collaborators, etc. And there are two routes for the same: automatic route and approval route. Okay. So external commercial borrowings means what? That you are raising your funds outside your country, okay, from a non-resident lender, example Citibank I told you, or let's say for example any Barclays Finance, which is there outside your country, okay. But this can be done either by automatic route or approval route. This is something which you have to remember in external commercial borrowings, okay. So taking funds from outside your country, okay. Euro bonds, as we have discussed earlier also, Euro bonds does not necessarily mean that these bonds are issued in euro denominated currency. Indian company issuing bonds in Japan in US dollars, that will be treated as your Euro bond, okay. Then there are foreign bonds, similar type, okay, where you are issuing bonds outside your country. Fully hedged bonds, it means that these are the risk of currency fluctuation exists, and fully hedged bond eliminate the risk. So whatever is your risk element involved in that interest payments, that gets hedged in the forward markets. So as I told you, in the forward contract, you at a fixed rate decide that at what particular rate the dollars payment will be done. So that was called as your forward contract. Similar to that, when a bond which is hedged with the foreign currency risk, that is called as a fully hedged bonds, okay. Then medium term notes, okay. So under this program, several lots of bonds can be issued having different features like different coupon rates, different currencies, etc. So these are called as your medium term notes. No need to remember this, it's okay. Floating rate notes, we have discussed this earlier, okay. Same commercial papers we have discussed, issued at discount, etc., but these are going to be in foreign currency, okay. Foreign currency options, like very similar to this option, whether you want to take the loan or not take the loan, etc. So you have a right but not an obligation, okay. Same foreign currency futures. Then again, once again, foreign euro bonds, as we have discussed earlier. Euro convertible bonds. Now here, there can be something which is called as call option or put option. So call option actually means what? That the company can call for this particular bonds earlier and give you the payment back, okay. Put option means you have a right to repay it, okay. So that is called as call and put, okay. Till now they have not asked these kind of different natures of this particular bonds, okay. So you can just remember some of the names of it and what is one feature of this particular bond, okay. Now what is this environmental, social, government linked bonds, okay. Now these bonds are actually issued, and the money which is being raised, that will be used for socially responsible investing. So these are called as ESG bonds. So these are environmental, social and governance linked bonds. So when I'm the issuer of these bonds, I'm raising these funds, but where am I applying this? I am applying this particular funds to socially responsible investing. Okay, so these are called as ESG bonds. So in this ESG bonds, there is project-based bonds and target-based bonds. So project-based bonds has green bonds and social bonds, and target-based bonds are sustainability-linked bonds. Now what is this? See, green bonds. These are the most popular ESG bonds that are issued by financial, non-financial or public institution, where the bond proceeds are issued to finance the green projects. Okay. So green projects are aimed for positive environmental, climate control, etc. So example, Ghaziabad Municipal Corporation becomes the first to raise 150 crores from green bond in the year 2021, and they are going to use this money for betterment of the environment. Social bonds. Now these bonds are being used for some, they are going to issue the bonds, and whatever money they are going to raise, that will be used for human rights, equality, animal welfare, etc. So these are called as social bonds. Sustainability linked bonds. Now here, as we know that there are carbon emissions, etc. So for that particular case, the money which will be raised, that will be used in such a way that they are going to reduce, they are going to employ plant and machinery in such a way that the carbon emissions is going to be lower. So I'm going to employ my funds in buying plant and machinery in such a way that they are going to be proving to be good for the environment. So that will be called as your sustainability linked bonds. Okay. So euro issues by Indian companies, the same part. Now these two are important, which is nothing but your American depository receipts and global depository receipts. Okay. And what is this Indian depository receipts? So let's say, for example, I want to raise the funds outside India. Okay. So how will I raise it? So I will go to, let's say, New York Stock Exchange and tell New York Stock Exchange that you please issue securities to your citizens. Okay. Whatever funds is generated, you give it to us. So basically what happens is, let's say Tata Motors, it approaches New York Stock Exchange. Okay. Now New York Stock Exchange, all its ADRs will be listed here. So they are going to issue this to US citizens. US citizens will give them funds, and this funds will be available with Tata Motors. Okay. Now these ADRs, okay, they will actually be traded in the New York Stock Exchange. But the most important part is the price of this ADR will be dependent on the price of this Tata Motors shares. So there is an underlying asset which is being involved here. So if the Tata Motors shares will fluctuate, then this ADR price will also fluctuate, because ADR is not an independent instrument. It is a derivative, and the underlying security is Tata Motors shares. Okay. So if Tata Motors share price will fluctuate, will the ADR will also fluctuate? Yes or no? Yes, sir. Okay. So apparently what happens is that Tata Motors, if it wants to raise the funds in US, what are they going to do? They are going to be involved in New York Stock Exchange. They will go to NYSE, okay, and list its securities there. Okay. And it is only traded in New York only, in US only. Okay. So that is why it will be called as your American depository receipt. But GDRs are more preferred, because GDRs actually can be traded in more than one country. It's a global depository receipt. So when you are going to issue your securities in London Stock Exchange, New York, etc., and multiple stock exchange, then that will be called as your GDRs. Okay. So probably in European countries, etc., in London, etc., so there the GDRs will be taken into consideration. Okay. Now always remember that GDR is very wider in scope as compared to ADR. The nature is the same. ADR is only traded in US, global depository receipt, across the world. Okay. And mainly in European countries. Okay. But the purpose is very simple, that if we want to raise funds outside India, so Tata Motors, if it wants to raise funds outside India, what are they going to do? They will issue ADRs and GDRs. Okay. Now what is IDRs then? So IDR means which is actually used to raise funds in the foreign currency, has been applied in the Indian capital markets through IDRs. So now what is happening is that, let's say for example, the funds are raised in foreign currency in the Indian capital market. So let's say for example, Tata Motors issues Indian depository receipts. Okay. But this will be issued in dollars so that people outside India can subscribe to this. Okay. So the concept of the depository receipt mechanism, which is used to raise funds in foreign currency, has been applied in Indian capital markets. So where are we issuing this IDRs? In India, but in which denomination? In foreign currency. Okay. So IDRs are similar to ADRs in the sense that foreign companies can issue IDRs to raise funds in the Indian capital market. So as Indians can go to US and issue American depository receipt, similarly Microsoft can come to India and issue Indian depository receipts, and people can subscribe to it, and that's how foreign companies can raise funds in India as well. Okay. Then what is this contemporary sources of funding? Okay. So this ADR, GDR and IDR, I hope you all have understood this. This is important from the examination perspective. And similarly, we have contemporary sources of funding. Now, what is this called? Crowdfunding, equity funding. Then there is something which is called as your peer-to-peer lending, startup funding, and donation-based crowdfunding. Now, what is this crowdfunding? So crowdfunding means what? Let's say, for example, you have a brilliant business idea. This is the first source, from which you can raise your funds. So you go to your family members and you tell them, listen, that I have a brilliant business idea, but I need funds. So then you tell your family, friends, etc. that you are going to you may or you may not issue equity, arrange funds from your own sources, then that will be called as your crowdfunding. Okay. What is equity funding? That equity crowdfunding mechanism where investors invest the money in an organization, receive securities of that organization in return. Every investor would be entitled to a stake in the organization depending upon their investment. So the digital nature of crowdfunding targets large number of investors with small contribution. So they are adopted by startups. So I am going to start with this particular crowdfunding where, I want to raise 10 lakh rupees and I am issuing the shares at 10 rupees each. So total 1 lakh shares are issued and people will subscribe to it and they're going to get the equity out of it. So that is called as your equity funding. Okay. So crowdfunding, basically they are going to collect money from family, friends, strangers, corporate, etc. Okay. And it can be in the form of equity or loans or nothing. Okay. There can also be donation. Okay. So that is something which you can see here, donation based crowdfunding. As you are aware that if suppose, many times, like for example, Impact Guru, what these guys do, there is donation based crowdfunding where you will start, we need a target of 20 lakh rupees and people can contribute to it. So that is called as donation based crowdfunding. Okay. And here, this is normal crowdfunding. This is from the business perspective. This is for another cause. Donation based is for another cause, for social cause. Equity funding means we are going to issue equity. Peer-to-peer lending. Now, it is that category of crowdfunding where the lenders match with the borrowers in order to provide unsecured loans through an online platform. So through an online platform, when there is unsecured loan which is provided, so that is P2P. The fund raised are paid back to the borrowers with interest though this kind of lending involves certain risk of defaults. Okay. And anyone interested in investing money under P2P can visit P2P lending platforms and choose amongst the borrowers. So basically what happens is there is an online platform in which, for example, I want to borrow funds, so I will list myself. And if suppose you want to earn a higher rate of interest, then you can visit this website and give the funds there. They will transfer it to me. I will give them interest and they will pass it on to you. So that is called as peer-to-peer lending. Okay. Then what is startup funding? A startup company being newly formed needs funds before starting any project. So then, before we start with a particular business, the funding which is required from banks or from crowdfunding, etc. So that will be forming part of your startup funding. And donation based funding, I have told you. Okay. So these are the different types. So what you should do is, for different type of instrument, now just remember that this instrument has which feature and remember that from the examination perspective. Okay. So I hope you have understood this much part, and with this your second chapter, types of financing, gets over. Okay. Pertaining to your theory part. Now let's continue this further and we'll now be starting with, as you all are aware that there is financing of working capital. In your module 2, when you're starting with your working capital, there is a little bit of theory which is covered here also, but you'll be very happy to see that whatever terms you have mentioned here, we have already covered in the second chapter. Okay. So in your financing of working capital, how do you finance your working capital and what are the factors which is taken into consideration? So there is cost factor, credit rating, feasibility, reliability restrictions, hedging approach, etc. Now, what are the sources of finance? So see, trade credit is something which we understood, which is something given by the suppliers of the goods. Bills payable, that is also one of the type of the credit which can be offered. Accrued expenses means your outstanding expenses. This is something which you understood there. Intercorporate loans and deposits, where one company will give loans to the others. Commercial papers issued at discount, redeemed generally at par, sometimes with interest, without interest, and denomination of 5 lakhs, from the short-term perspective. So these are commercial papers. Okay. Funds generated from operations, when you generate funds from the operation and use it for the purpose of expansion and growth, something very similar to internal cash accruals. Then public deposits, you can issue that and raise the money from the public. Bills discounting is also something which we understood. Same bill rediscounting scheme, not that important from the examination perspective. Factoring. Now factoring is something which we have discussed in receivables management. So where, from your, you can, sell your receivables to a factor and factor is going to give you funds. So that is something which is there in the factoring part. And you can take this money from, your banks as well. Okay, so what are the forms of bank credit? So this is something which we discussed: cash credit, bank overdraft, bill discounting, bills acceptance. All these things we have discussed in the second part: line of credit, letter of credit, okay, bank guarantees, etc. So these are the different forms. So only just remember these terms when it comes to forms of bank credit pertaining to your financing of your working capital. Okay, now very quickly let us go through your last PYP papers. So in all I've covered like around from May 24 PYP till now. And what are the different types of questions which are asked? So question number 4, which usually comes as an optional question: what are the list of questions and the solutions which are here? Now you'll be able to understand that how easily you'll be able to connect it with the chapters which we have done. What are the repetitive types of questions and what type of theory questions they can ask in the examination? Okay, this theory you can get it from our Telegram group. Okay, so link is there in the description. You can take that into consideration. Okay, now see, very quickly let us read what are the types of questions. State with brief reasons whether the following statements are true or false. Maximizing market price per share as a financial objective which maximizes the wealth of shareholders. So is this true? Then the answer is absolutely yes, because when you are maximizing shares, then the wealth of the equity shareholder increases. So this was the first statement. The second statement: a combination of lower risk and higher return is known as risk return trade-off. Lower risk, higher return, yes. And at this level, risk return profit is maximum, no. So now in this particular case, there is a direct relationship between risk and profits. Higher the risk, higher is the possibility of profits. Okay, so that is why lower risk and higher profits is a myth. So it's a false statement. Higher the risk, higher the return. Third statement: financial distress is a position when the accounting profits of a firm are sufficient to meet long-term obligations. False. We have understood this in the very first chapter of distress, where we are not in the position to repay the funds. Okay. Fourth, angel investors is one who provides funds for startup in exchange for owners and equity. Yes, of course, yes. Angel financing is being used for the purpose of equity finance. Okay. So these were, the true and false statements which was asked in 4A. 4B, ABC is approaching the bank for financing its business activity. You are required to describe any 4 forms of bank credit. Just now we have discussed that for the consideration of the company. So what are the types of bank credits which we can get? So bank can offer cash credit, bank overdraft, bill discounting, bill acceptance, lines of credit, letter of credit. Just now what we discussed here, forms of bank credit. Okay, the same thing is applicable here. So these are the different types of the bank credit which can be offered. You can definitely write down this in your own words, and any 4 points are okay. So there is no need to write down these 7-8 points here. Okay, so these are the different types. So see the number of points which they have given to you, but here we can just write down any 4 points and do that accordingly. Okay, then discuss the relevance of payback reciprocal in capital budgeting decision. Now what is this payback reciprocal? Okay, see, reciprocal of the payback period is a close approximation to IRR if the life of the project is at least twice the payback period and the project generates equal amount of annual cash inflows. So let's say, for example, let me put it like this: cash inflow per annum, if they are constant, and if I multiply that by annuity factor at 10%, let's say for example for 3 years, I get PV of CI. And suppose your IRR is at the rate of 10%. So whatever is the PVAF factor which you get, that will be treated as your payback period. So what do I mean by this? Suppose my cash inflow per annum is 1 lakh. Okay. Now what is the PVF at the rate of 10% for 3 years? So 1 divided by 1.1. 1, 2, 3. Okay. And in this particular case, this PVAF is, let's say for example, coming as 2.4869. Okay. And if I multiply this by 1 lakh, so my PV of CI is coming as 2,48,690. Suppose this is my PV of CO. So that's why this will be treated as my IRR. So this 2.4869 will also be treated as my payback period. Okay. So that is something which deals with your, IRR and payback period relationship. Okay. So payback reciprocal is nothing but 1 divided by payback period and something like that. So you just have to remember this, but this concept will be applied when the cash inflows per annum are constant and we have reached our IRR rate. So whatever is the annuity factor, that can be treated as your payback period. Okay. So as you can see that if your PV of CO is Nothing but 2,48,690. And if we divide that by 1 lakh, so what's your payback period? That is nothing but 2.48 years. Okay. So then your PVAF, that becomes nothing but your payback period. Now, what is the next part? The next part is explain the features of crowdfunding. So crowdfunding, which we have discussed there, where a particular target will be met, and then we are going to issue equity funds, and we can also give them by the way of loans, etc. So there is an online platform on the basis of which this crowdfunding can happen. So whatever we have discussed there, this is the first step. For example, you need funds, but you're not getting from banks, etc. Then you can approach crowdfunding, approach your friends, relatives, friends, etc. And then strangers, corporates, and from that take the funds and meet your target. Okay. So this was pertaining to your May 24 questions. Now September 24 PYP questions. What are the two advantages and disadvantages of issuing debentures? Okay. So advantages, best part is what? That there will be interest. There is no result in dilution of control. Why? Because debt is not part of equity. And when the prices is going to increase, whenever the interest cost is going to increase in the market, when you have issued debentures at a fixed rate, then your cost of borrowing remains constant. So that is one of the advantage. And disadvantages is going to be, debt equity ratio will be higher and stuff like that. Okay. So basically all these things what we have discussed in the theory part, that is taken into consideration here. Okay. What is the second part? List any 4 assumptions of Gordon's model. So here in your Gordon's model, there is going to be an all equity firm. IRR will remain constant, KE will remain constant, retention, growth rate will remain constant, KE should be greater than G. So always remember, your KE will be constant. This is one of the assumption of Gordon. So whatever is the expectation of equity shareholders, we assume that to be kept constant throughout. Second, your growth rate is remaining constant, because that in dividend decisions we did this. When there is a 2-stage or 3-stage growth model, only then the Gordon's model can be applied after the growth remains constant. Okay, so growth should be constant. Third, your KE should be greater than G. That is something which you have to understand. Okay, and all investment proposals are to be financed through retained earnings only. Okay, so that is one of the assumption of Gordon. Okay, so these are some of the assumptions which you can remember it. And then they have asked you what is leverage lease, what we have just now discussed. Under your leverage lease, what happens is that there is going to be a third party who is going to finance it. Do you remember that solar company example in which there is a lender, there was an escrow account, and what is going to happen is that there is a lender, there is one investment bank, and there is one company which needs to install a solar plant. So what happens is that a lender is going to finance 80% of the funds, and we are going to give that to the to this particular person, to this solar company who's going to install it. And this first lease rental will be used for recovering the lender's payment, and the balance will be given back to the lessor. Okay. Depreciation, etc. will be charged by the lessor. Then what have they asked you next? That what are the remedies for overcapitalization? So what is overcapitalization? Means, for example, there is too much of equity which is floated in the market. So then they should go for reorganization. They should buy back some shares. They should be involved in reduction in claims of debenture holders and creditors, and value of shares may also be reduced. So when there is too much of equity in the market, it's not a good thing. So we have to curtail that particular equity by buyback, etc. So that is, we have to bring from overcapitalization to undercapitalization. Okay. Now in Jan 25 PYP, explain environmental, social, government links bonds. So something which we just discussed, that how can we protect yourself from these kind of bonds, or how can we have such kind of bonds into the nature where the bonds, the money raised from issuing these bonds will be used for the purpose of good economic causes. Okay, for environmental cause, for social cause, and for government linked bonds. Okay, so then there are green bonds which are there. Okay, social bond, sustainability linked bond. So that municipality one municipal corporation had issued this bonds for the purpose of using it, so that those were called as green bonds. Social bonds for human rights, vaccine bonds, etc. And then we also discussed sustainability linked bonds, like issuing bonds and using that money in such a way that there is environmental sustainability. Okay, reduction of carbon emissions, etc. So all those things. Now, what are the objectives of wealth maximization? Long-term goals, reduces risk uncertainty, timing of the returns, and considers shareholders return. So that was your B part, which was wealth maximization goal, objectives and advantages. Okay. Then what are the two advantages of virtual banking? And or they have mentioned what is the concept of exclusion of financing cost principle. So first let us understand this. What are the advantages of virtual banking? Low cost of handling a transaction, increased speed of response to the customer requirement, lower cost of operating branch network, etc. And it allows possibility of improved and range of services. So all these are the advantages of virtual banking, something what which we are being using very often now. So you don't have to go to banks for a variety of things. You can do it via app. So that all these things are really going to be very helpful. So that are virtual banking. That is something which you can write in your own words as well. So there is nothing of this sort which is given in the ICAI study module. Okay. Now what is the exclusion of financial cost principle? The interest on the long-term debt is ignored while computing profits. Expected dividends are deemed to be irrelevant in the cash flows. Now, exclusion of financing cost principle. So when we are excluding the financing cost, it means that whatever interpretation we are doing in the financial statements, that is done without considering your interest part. So that is called as exclusion of financing cost. Okay. Now in your May 25 PYP, what are the types of question? What is an agency cost and what are its types? So I explained you that in the first chapter, last concept was your agency cost, in which we are the owners of the company, right? And also at the same time, when we are the owners of the company, we have appointed a CFO who's going to take care, of whatever is going to be done pertaining to your managing of the funds or objectives of wealth maximization, etc. So in this particular case, we discussed that in sole proprietorship concerns or in partnership firms, the owners themselves, they are the fund managers. But when it comes to companies, it is the CFO who's going to manage the funds, and we are the equity shareholders. So we appoint an agent, so CFO, who's going to manage the funds on our behalf. So agency cost, will be definitely there. But how do we try to meet our objectives is that we can give them proper and adequate, incentives in a way that the wealth maximization goals can be achieved. Okay. Features of bridge financing, that is also something which we have discussed, that if you can recollect, we have to take long-term funds. But when we are taking long-term funds, it is going to take time to, arrange for the long-term funds. So for that much period of time, when we go to the banks and get some short-term funds to bridge that particular finance, it is called as bridge financing. So let's say, for example, if I want a loan for the period of 5 years, but it's going to take 6 months. So then from 0 to 6 months, when I need this particular amount, then that is possible with the help of bridge financing. Okay. What is the hierarchy of pecking order theory and what does this exist? Okay. So here we discussed agency cost, types of agency cost, and key features of bridge financing. We discussed all these things also. Hierarchy of financing, pecking order. Pecking order theory suggests that the managers may use various sources for raising funds in the following order. Manager's first choice is use internal finance. So that is the first, that try to expand with your own funds first. In the absence of internal finance, they can use secured debt, unsecured debt, etc. And they will issue equity shares as the last option. So this is called as your pecking order. Now, why debt first over equity? Because debt is a cheaper mode of finance as compared to the equity. Okay. Then they have told you that in this particular part, the total risk of the degree on operating leverage is being given to you. Your comment should depict the total risk profile and the most appropriate among the 3 words. Okay. So degree of operating leverage, low and high. Okay. So what are the comments which you have to put? Now, if suppose degree of operating leverage in a particular company is low and its financial leverage is high, it means that the total risk is going to be moderate and it's a best combination. Higher financial risk is balanced by lower business risk. Now, if the operating risk is high in a company and financial risk is lower, then also the total risk is going to be moderate, but not a good combination, because the EBIT is low because the operating risk is higher. But if both the thing is high, then the total risk is also going to be high. It's a very risky combination. Okay. So if suppose your operating risk is low, financial risk is high, what does it mean? That the business risk is moderate. But if the operating risk is high, financial risk is low, total risk is moderate, but not a good combination. Why? Because if operating risk is higher, your fixed operating cost is higher, then in that particular case, definitely you will be earning lower EBIT. Okay. In your September 25 PYP, what is given to you, discuss two advantage and limitation of stock splits. So stock splits, as you are aware, that the face value gets divided into different parts. So first, suppose the face value of one share was 10 rupees. Now it is possible that the company can have 4 shares of 2.5 face value, something like that. So that's called a stock split. Okay. So it makes the share affordable to the small investors. Now, as you all are aware that, let's say for example, MRF, it is traded at a share price more than ₹1,00,000. Now in this particular case, small investors cannot invest. But when you break that shares into multiple numbers, so there is a stock split. So more and more people can invest in it. Okay. So number of shares will increase. Okay. And what are the limitations here? Additional expenditure needs to be incurred, and low share price may attract speculators. So there can be more speculation. So in companies like MRF, speculation chances are very less. Okay. Then explain the following: callable, puttable, masala, and drop lock bonds. So all these things we have discussed there. Callable, you have a right to go, the company has a right to redeem it before its maturity. Puttable bonds means what? You have a right to go and redeem the bonds before its maturity. Masala bonds, these were Indian bonds which were issued in foreign currency. Drop lock bonds, if it falls below the limit, then the interest rate is going to be fixed. All these things we have discussed there. Explain the 2 basic functions of financial management. So all this also we have understood in the first type of bonds, in which the masala bonds was a rupee denominated bond. Okay. These were sold in the overseas market. Okay. Now, what are the basic functions of the financial management? So investment, financing, and dividend decisions. Okay. Along with your working capital. Now, what is the limitation of profit maximization? All this you have to refer to the first part of the chapter. All these questions we have done there. Okay. Jan 26, last paper, PYP. What is seed as capital assistance as a source of finance? Just now we have discussed, in IDBI Bank, they offer seed financing capital assistance, right? We discussed that. IDBI, professionally managed, technically, etc. to, people who are good from the skills perspective, but they don't have money available. So they can approach IDBI. Okay. And also at the same time, what is the second part? What is the virtual banking service amongst the customers and advantage of virtual banking? Just now we discussed that how online banking plays a very important role as compared to going to the bank. Financial distress, also first chapter, last part. Financial distress means the company is not able to repay the money. Okay. So that is something which is given here. It's that where the cash flows are inadequate to meet its current obligations. Okay. And then what is the last part? B Limited has a current ratio of 2:1. Showing enough short-term liquidity in the company. You are required to comment whether the current ratio will improve, decline, or remain unchanged. Okay. So these are the 4 transactions and what is going to be the impact. A debtor owing 60,000 becomes insolvent and only 75% is recovered under full and final settlement. So the current ratio is going to definitely decline because the debtors entirely are not getting converted into cash. Okay. Only 75%. So current ratio will fall. Then second, issued equity shares and kept it in the current account. So current ratio is going to improve because your cash bank account is going to be much more better. 25,000 collected from the customers in cash, no change because debtors are getting converted into cash immediately. Goods costing 80,000, 8,000 is sold for 12,500 on credit. Of course, your current ratio will improve. Why? Because goods which were recorded in the books at cost, now it's getting converted to debtors and we are selling it definitely at the profit margin. So the debtors are because there is going to be increase in the amount of receivables. So that definitely your current ratio will enhance. So with this, my dear students, we complete your PYP papers. Now your RTP also has same type of questions. Okay. Wealth maximization and all those things. So I have kept question and answer here. Okay. In your RTP as well. So what you can do is, these are same type of questions. There's nothing new which is asked in the RTP. Whatever we have discussed in the study module, the same type of questions are repeated, but this is in question answer format. So this sheet will also be available to you in your theory part in your Telegram channel, which is there in the link. So if you want to just refer to this in question answer format, you can definitely go through it, but there is no new concept in your RTP. Okay. So with this, my dear students, we are done with your entire FM theory. This one video, you have to watch it so that you understand everything regarding your theory part, and just remember the terminologies and one factor of each and everything, so that you'll be able to present this in your examination. Okay, so that's it, my dear students. Take care. Bye.